Good morning. It is Monday, January 30th here in New York City. This is Yahoo Finance Live. I'm Julie Hyman with Brad Smith and Brian Sozzi, and we are seeing futures definitely indicating a lower open here this morning. Big week this week, a lot of central banks meeting. We've got a lot of earnings, and it looks like there's some pessimism that has now been creeping in after a rally that we had seen in tech stocks to start the year. S&P futures pointing to a drop of about 0.75% at the open, and Nasdaq 100 futures are performing worse. They are down by a little more than 1%, although we are not listening to me this morning on the interactive. There we are. Nasdaq 100 futures now down by a little more than 1%. And this is as we are setting up here for all of this central bank activity this week, and we're seeing yields go higher. We've seen that inverse relationship between them and tech stocks in particular. So we're going to keep watching that, Saz.
We are all listening to you, Julie, myself and Brad. But right now, Wall Street is set to face one of its busiest weeks of the year with more earnings on deck and the Federal Reserve's first meeting and rate decision of 2023 on tap. Fed officials are likely to raise interest rates by 25 basis points on Wednesday, with Chair Jay Powell set to offer signs on the central bank's path forward. And this is a market that's enjoyed a good January, guys. I think under this notion, we get that Fed pivot, perhaps in the back half of this year. We're not getting any more of these rate hikes, but I'm starting to see some of that pushback on Wall Street here, looking at Evercore ISI's Krishna Guha saying you still have to be on high alert for a hawkish Jay Powell.
Yeah, and one thing as we've continued to talk about the Fed and the broader central bank activity around the world, perhaps it was just me trying to start off my week on a different note. I over-indexed on the ECB and what they're doing, and the sights are really going to be set on not this meeting necessarily, as this one is kind of telegraphed, but even further out into the year, you start to think about what the likelihood of a deeper recession may look like in Europe and what the ECB would be tracking towards. And September seems to be the timeline that much of the modeling is really looking at this point in time, and at that September 2023 meeting where they might start to at least pause some of the pathway in their own rate hiking strategy as well.
Yeah, and I guess the question, whether it's for the ECB or for the Federal Reserve, is one that the Wall Street Journal's Nick Timiraos explored in a story out today where he talked about the lag of policy effect. And it has been sort of conventional wisdom that it was a long and variable lag. In other words, the Federal Reserve raises interest rates and it takes a while to feed through to the economy. But as he outlines, there's now a debate over whether that is still the case for a number of different reasons, among them the fact that the Fed is now much more transparent and communicative and tells us what they're going to do before they actually do it. So does that then collapse that lag that we had seen traditionally? So if the lag is shorter, what does that mean for policy? So there's just a lot of sort of academic discussion that has real world implications around all of this stuff right now.
Yeah, I love that chart from our friend Torsten Slok, chief economist over at Apollo. Of course, Apollo is the parent company of Yahoo, but he's noting the average gain after the Fed funds rate peaks, 15% for stocks. And I think that's what you're seeing, I think the market, at least in January, trying to get out in front of.
Yeah, well, some of the companies that could be highly reactive are also companies that are reporting earnings this week. We've got some big earnings on tap this week with two automotive giants, Ford and General Motors. They're set to report amid signs of waning demand and rising interest rates that have raised the prices of car loans as well here. And for what we're going to be tracking this week with Ford, is anything continuing kind of the conversation from last week and Tesla's earnings and the focus on electric vehicles is just how many of the electric vehicles they're continuing to see orders for, as well as for GM, because essentially all they've done is taken the cars that had, or at least the models that had the highest brand equity to them, and just slap an EV tag on it basically and try to make it batterized or battery efficient. And so with that in mind, it's going to be a battle of the battery too. That's something that we heard from Tesla on their earnings call last week. But for Ford and GM, expect to hear about the battery, expect to hear about the orders, the deliveries, of course, but how quickly the consumers is shifting to that EV offering that's on the market, even as some of the car prices are being monitored extremely closely by consumers.
Yeah, the market's really watching these car prices, Brad. You know, Ford come out and cutting that price, that Mach-E this morning, stocks at session lows. But as for me, I'm watching Meta, big earnings report from that company. And really, I think this is the first quarter where you could start to see some of these cost-cutting initiatives bear fruit in the company's bottom line. I think the street is very focused on how these cost cuts will weigh on profits as the year goes along. Good chart here from Brent Thill over at Jefferies, looking at some of the cost cuts Meta has made since December. And one of them, just interesting here, it looks like they're really not leaving any stone unturned to save some money. They're actually, this month, they laid off more than 100 cafeteria workers at Meta. So something worth noting there as well. But again, to what extent in one quarter do these efforts collectively start to improve profits, I think is very much in focus for the stock.
And I am watching Amazon, which is out Thursday after the close of trading. Obviously, it's hard to pick this week because there are so many different companies that are reporting here. And we're going to be watching Amazon because we keep talking about how the spending in this country is shifting towards services from goods. Amazon straddles both, of course, because it sells a lot of stuff, but it also sells a lot of services, mostly in the form of cloud services. As we know, it's dominant in that cloud market. It has the biggest market share of any of the companies that attack the cloud. But as we also know, enterprise spending has been waning a little bit. And so we'll see if it is seeing as big growth as it has seen. If you look at the revenue last quarter, I feel it's useful sometimes to take a step back and say, okay, where does Amazon get its revenue from? How big exactly is AWS? AWS only actually makes up about 16%, or did last quarter, of the company's revenue, but it is very profitable and provides good margins for the company. The online store is still nearly 50% of the overall company, but then there are third-party seller services, which are now sort of broken out separately from the overall online store. Then you've got ad services and subscription services and the actual physical stores, i.e. Whole Foods. So it's just interesting here because we'll get sort of in one company a read on what's happening on these different sides and aspects of the economy.
And you're going to hear a lot about the pricing strategy from each of these companies that we're talking about as well in the future. For pricing for Amazon, that may look different across some of the Prime members that they have. And any time you see a change like that, how that could potentially affect membership. For a company in Ford, we were already getting news this morning as well that they're planning to cut their prices by about $600. That's on the Mach-E, and that's getting back to that EV,
electrification.
The electrification of something that was already popular. It was the Mustang Mach-E at first, and now it's just, I think, the Mach-E. And so with all of the different changes, pricing related, or even at Facebook, some of the input costs that they do have that ultimately change the prices for how advertisers, and especially given the fact that advertisers are less willing to spend as many dollars perhaps on a Facebook, given that they're monitoring their own spends. All of these things kind of connect together and give you a sense of how each company is kind of pulling pricing levers in a different way because of the demand environment right now.
Yeah, I think just going back into Amazon retail, I think we learned from that Hasbro warning last week. This was a very disappointing holiday season for a lot of retailers. That Amazon retail business likely under pressure, which raises the question, has big tech cut expenses fast enough? I know we've been covering all these layoffs, thousands of layoffs over the past 2 months or so, but is it deep enough? Is this just a sampling of what could be to come as a lot of these companies battle just accelerating slowdowns in their sales and they have to meet these estimates on Wall Street?
Yeah, a lot to consider. It's going to be a busy week for us. Ahead of that, let's zoom out a little bit. We've, of course, had a lively start to the stock market this year after experiencing the 7th worst year for the market in 2022 since the 1920s. But was this January as good as it's going to get for the year? And where do we go from here? A new survey shows investors have little confidence in stocks despite this month's surge. JP Morgan out with a note as well this morning, echoing that sentiment. Let's dive into it with Baird Managing Director and Market Strategist Michael Antonelli. Mike, good morning. Good to see you. You can take it whatever way you want. You have on the one hand the old saw, as goes January, so goes the year, and we've had a good January. On the other hand, there is this sentiment out here that this is as good as it gets. Which camp do you fall into?
Good morning, Julie. Good morning, Brad and Brian. I read Brian's note this morning about being a bizarre moment, and I think that's right. I've been trying to explain this to not only our customers, but to other kind of colleagues. Like, why is this such a bizarre moment? And I think I've landed on one thing, on whether what we're going through now is kind of as good as it gets. Markets over the very, very short run trade on rate of change, right? We know this. Like, are things getting better or are things getting worse? And I think that the move we've seen in January is all about rate of change, okay? And rate of change is enough to get you over some lines on a chart. That's enough to get you over a diagonal line on a chart or a moving average. So what does that mean? That means, well, things weren't as bad as we thought. Maybe they're getting a little bit better at the margin in things like inflation and housing and the job market. So that rate of change is enough to get us to where we are, but that's not enough to kind of really push us into the stratosphere, to push us like much, much higher. So that's what I've landed on. We're in this situation where technicals are good, but fundamentals are kind of bad, which is, I think, is essentially what Brian was saying this morning.
Michael, thank you for recapping my morning brief newsletter. And of course, you can read more on the Yahoo Finance homepage. But look, what do you think February has in store, Michael, just given we might see just a rethink of how fast markets have come out of the gate this year?
Yeah, like you guys said, it is a busy week. I mean, the number of stocks reporting this week, I think it's 107 S&P companies, 6 of the Dow components, a Fed meeting. So we're going to kick off the month with plenty of data to digest. I think I came on Yahoo Finance the last time I was here and said I think the Fed's one more 25 hike and done, and I'm going to stick with that. I'm probably out of consensus for sure. I think they're going to look at some of the data and say, all right, this long variable lag we mentioned, and the fact that we've done enough already. I think we do get another look at CPI and earnings. So I think February has in store for it a lot at the front end of the month, and the front end of the month is going to basically set the tone for the whole entire, maybe the rest of the quarter here, basically. But we need to see the market defend the 200-day, defend this kind of downtrend. That will be an important part of the first part of the month. But ultimately, it's going to come down to these 107 companies that are the kind of the bulk of the earnings.
But how much is the market still lingering on every single announcement from the Fed right now? Is it pricing? And I ask that because of the reasoning. Is it pricing in a terminal rate, or is it just kind of lingering on the in and out or the minutia of every single meeting and taking them as individual nature?
It's a great question. You could argue this from the bullish and the bearish viewpoint. The bullish viewpoint would tell you this: when the market can get its arms around the kind of worst case scenario for Fed funds, that's a powerful thing. When it can take off the table a left tail of 6, 7, 8% Fed funds, that's a good thing. That means the market can see the finish line. And I think that's where we're at right now. I think it's taken off those worst case scenarios in the Fed funds rate, inflation, wage spiral, all that stuff has been taken off the table. And that's an important component of what the market's doing. On the bear side, you would say, yeah, what if the Fed comes out? What if Powell comes out and says, look, I'm still hawkish. We're still hiking. Forget it. The financial conditions are easing. Forget it. So the language, right, could be a real headwind for or in the positive camp for the bears. But I think what's really, really important, just to summarize that, is we've taken that worst case scenario off the table in terms of Fed funds. And that's just outright bullish. It's outright good for risk.
Yeah, I guess the bears would say maybe the market's not right to take that scenario off the table, to your point about bearish language. I want to get to earnings for just a second, Mike, because earnings on average have not been beating estimates, right, or at a lower rate than they typically do. How does this earnings season feel to you? I guess if we're getting touchy-feely here, how does it feel to you? Is it as bad as anticipated?
FactSet pointed out, and Brian had in his note, that the growth rate's actually negative. It's about minus 5%. The growth rate. This would be the first time since, I would believe, 2020 for the earnings growth rate. All that stuff is really well and good. Talking about the stuff is great, and it makes for good tweets and it makes for good conversations. But price action's everything. This is the trader in me speaking now. Price action's everything. When you see a bad report and a stock goes up, say Microsoft, for example, when you see something that raises your eyebrow, like, wow, that looked bad, but yet the stock is up and the market's shrugging it off. That's the clue. That's the real information coming out there. So what we're going to want to watch this week, Meta, Amazon, those companies, Apple, we want to watch, how is the reaction? Is it a bad data report? Fine. That goes into some metric in a data sheet. But how is the stock reacting? Because even if it's bad, remember, it doesn't have to be good news. It just has to be less worse. Back to this rate of change thing. So while we're starting off a little slow, price action's been pretty good, and I'm taking solace in that.
All right. Great to have you here with us to kick off this week. Baird Managing Director Michael Antonelli, always a pleasure to get some of your insights.
See you guys.
See you. Coming up, why it's a bizarre time to be an investor. Sazi's going to break down today's aforementioned morning brief. That's next. Markets off to a rocking start this year, but according to our very own Brian Sozzi, it's making for a bizarre time to be an investor. For more on this, let's go over to Saz to break down this morning brief. Saz.
Hey, I'm over here now, Brad and Julie. Let me tick through these right now. We have the full morning brief on the Yahoo Finance homepage. Check it out. But a couple points here worth making and why I'm calling this just a very bizarre time to be an investor. It's always a bizarre time, but right now is super bizarre. First up, like Michael Antonelli was just saying, this so far has been not a very good earnings season. We've seen a lot of earnings not only just decline year over year, but flat out miss consensus estimates, and the outlooks for earnings and even sales, I should mention, not exactly good. Number two, the layoff beast has been unleashed, yet stocks are still rocking. All these layoff announcements started to come from Microsoft, Amazon, you name it. They have now started to spread to the industrial sector, like a 3M when we learned when they reported earnings last week. I suspect you might see some layoffs now coming from the consumer space, but again, they report earnings in February. And last but not least here, no clear sign the Fed chief will be a dove, yet stocks are still rocking this month. And of course, guys, we'll learn more about that tone from Jay Powell when we have that big Fed meeting this week.
Yeah, I mean, it's not the first time that we have seen stocks go up at a time when, or risk on at a time where it's not exactly clear that they should be. I was just looking at the groups in the S&P and what they've done so far this year. We have communication services as the top group. That includes stuff like Meta, right, and sort of the social media companies. Consumer discretionary is number 2. At a time when we saw consumer spending, we got the numbers last week for December, consumer spending in December fell, and yet consumer discretionary stocks are up. And finally, tech stocks are in the number 3 spot. Then you have real estate after that, by the way, which is traditionally a defensive group. So,
yeah, nobody cares about this.
So bizarre, but I mean, that is bizarre indeed, right? Yeah. That we see that kind of mix of cyclicals and then, a defensive in the number 4 spot as doing well this year. It's a confusing time.
It is a confusing time, and especially when you do have some of the more bullish sentiments still being around some areas that have performed well last year. And so for that trade to still be intact, or at least top of mind for some investors, and thinking about energy, and then additionally, you think about healthcare as one of the thematic plays for 2023 that continues to get brought up. This could just potentially add on, at least in the first half of the year, until we do see more of that mullet trade that I keep bringing up that Brent Thill discussed with us on the show before. If you see more of that party in the back, where could some of the high growth internet names, you're laughing, Sauce, where could that come back in to play for portfolios?
All right, let's stay on the bizarre here and move off of mullets. Apple could be a key catalyst in the days to come. Let's look ahead to what our next guest calls the tech Super Bowl of earnings. Wedbush senior analyst Dan Ives joins us now. Dan, always a great way with words. What do you expect from Apple when they report? We're talking about this has been a bizarre earnings season so far. Could we see a disappointment from Apple on iPhones and guidance, but the stock still goes up?
Yeah, look, I think that's been the theme, just like Microsoft, and I think Tesla as well, right? In terms of just this narrative, I think with Apple, demand's holding up better than feared. I mean, that's what we've seen coming from Asia, and shortages clearly with the issue December quarter. There'll be some cautionary comments from Cook, but I view it as a positive catalyst because right now, Street's sort of fearing what ultimately Cook's going to say. And I believe the demand story in iPhone 14 Pro holding up better than expected.
So what is this going to tell us about the consumer right now, or even the consumer going forward in the next quarter and perhaps even for the back half of this year?
Look, I think it shows a stronger consumer than I think many would have thought where we'd be today. I think, look, the biggest issue with Apple is they have a golden install base, almost, right now, billion iPhones, and about over 20% of them have not upgraded their iPhones. So you have 220, 230 million iPhones haven't been upgraded in 4+ years. That gives them unique, I think almost Rock of Gibraltar-like ability to navigate this storm. And I think many have counted Apple out many, many times, no different than Rocky. And I think Cook is going to sort of flex the muscles Thursday night, along with the rest of tech. And that's our view. It's going to be a positive week for tech, despite many fearing it.
Rock of Gibraltar to Rocky. The
analogies
coming fast and furious here, Dan. If we take a step back for a second and just go to the theme of what Saz talked about in his note, this sort of, bizarreness, right, of this rally we've seen this year. What are you hearing in your discussions with clients? Are they sort of still confused, unsettled, uncertain in this market about some of the price action we've been seeing?
No, Julie, I mean, I tell you, like after these conference calls, like phones lighten up because investors sometimes can't understand the price action the next day. I think Microsoft is a perfect example, but my view is tech stocks institutionally is probably as underowned as I've seen since 2009. So no one's position for the sort of bad news is priced in. That's what we've seen from Netflix to Microsoft to ServiceNow, and of course to Tesla, which is, I think, is the short covering for the ages. And that narrative, I think, is going to play out this week. Tech firms, they're cutting costs after spending like 1980 rock stars the last 4 to 5 years. And once Wall Street sees numbers are sort of lower, then you could buy these stocks.
Dan, do institutions want to see layoffs from Apple?
Well, first of all, Apple never hired at the pace of these other tech giants. You'll see cost cutting around the edges, but Cupertino, I mean, they're tacticians. That's why they never had that sort of, what I almost call that pandemic sort of wave that many of these tech firms are hiring, called 15, 20% more workers per year. They'll cut around the edges, but I think it just shows why Cook is the Hall of Fame CEO. And I think he's able to navigate another situation here in terms of not needing to do the layoffs that other tech firms have done.
And you, Dan Ives, are a Hall of Fame analyst. Dan Ives from Wedbush, always good to see you, my friend. We'll talk to you soon. Appreciate it.
Great to see you guys. Thanks.
Coming up, SoFi and Lucid have hot ticker pages on Yahoo Finance this morning. We'll dive into each next. Welcome back. Ahead of the opening bell on Wall Street, let's hit a few hot tickers here. First up, Lucid on reports that Saudi Arabia's public investment fund is working on plans to buy out the rest of the electric vehicle maker. And this stock has been a colossal disappointment since the company went public, down about 56% over the past year. And I think it comes at a time where, as you were talking about earlier in the show, guys, pricing under pressure for electric vehicle makers. And the promise for Lucid was that they could come out here and charge extremely high prices for its cars and then ultimately at some point turn profitable. That thesis is really being put to the test.
Well, they're going after a different type of buyer. I mean, this is on the ultra high-end luxury side of the EV market. Play that Tesla had very early on. And what was that strategy? It was to say, at least for Tesla's entrance into the space, it was all about how do we make sure that these vehicles look and feel sexy? How do we make sure that the more affluent consumer out there sees it as something that's perhaps on a pedestal and bring the rest of the EV market with it? And who do you have at the helm of Lucid to begin that journey? You had Peter Rawlinson, who is one of the chief engineers of those very luxurious vehicles over at Tesla, bringing the same model over to Lucid. They had a record year, at least last year, in being able to produce 7,180 vehicles. So it's really just how do they compound on some of that production that they were able to showcase in 2022 and here in 2023, even as some of those more affluent consumers may be looking across the vehicle lineup that they have. Do you need a Lucid, or do you need something else that's going to be out there in the market, especially given the fact that Mercedes-Benz and their vehicles in the EQ class, that's going to also be hitting some roads this year too.
Yeah, and aside from the fundamentals of the company, now the question is, are the backers of the company going to step in and do some sort of financial engineering or buy it? So the report that came out on Friday, which caused the stock to spike as much as 98% before it closed up just 43%, was that the Saudi Public Investment Fund might be interested in buying all of the company. Now, this was highly speculative. The report sort of acknowledged that it was pretty speculative. It was in Betaville. It was a Betaville report that, again, sort of said this is just kind of chatter at this point. So that also kind of helps explain why the stock this morning is now, which was up a lot earlier, is now up something like 1%. So is it going to happen? If that doesn't happen, will something else happen that sort of supports the stock? It's unclear.
These cars, I've always thought the Lucids were just beautiful cars, but I can only imagine taking this to get this car serviced. One little thing wrong. Wow, that could be a real wallet buster. I mean, it's mostly screens in here. It's amazing.
It's the future.
Well, the future is going to be very expensive, Brad. It's going to be very expensive.
Well, I mean, isn't that like a Tesla?
I think this is a little more advanced than a Tesla. Just the interior-wise. Interior-wise in Tesla, you're just getting a giant hulking screen. I think the Lucid's a little more advanced and push that forward.
Well, where do you see the inside of that Mercedes EQ? It's just
Nice.
screen there, screen here, screen in the back.
One thing goes wrong.
Yeah, it's going to be tough.
All right, well, we're coming up on the opening bell on Wall Street in just a few. And as we've been talking about, investors looking ahead to the Fed and the ECB and the Bank of England this week, all of them making rate decisions, this at a time when we're getting earnings reports that by and large are not fantastic, given what we've seen thus far. So all of that seems to be weighing on sentiment this morning, particularly on the Nasdaq, ahead of what is going to be a very busy week for tech. Apple, Amazon, Alphabet, all going to be reporting their numbers later in the week. There we have the opening bell and this lower open that we're looking at. We were talking earlier about how some of the groups this year that have done better are some of the cyclical groups, the communication services, discretionary tech of the world. So we'll see what ends up leading in today's session and whether some of those same trends are intact. It does seem like there's a pause happening, a reappraisal happening as we get to the end of January. January does tend to set the tone for the rest of the year, but as we know, strategists on average are looking for tepid gains this year.
Yes, the market really nervous, Julie, on two fronts. Of course, to have that Fed meeting, and if the Fed chief doesn't signal we are getting a pivot, I mean, that would really undercut, I think, a lot of the dovishness or the bullishness we've heard or felt in the markets, to Michael Antonelli's point, so far in January, but also Apple earnings. Apple disappoints. That's going to be really pressure this broader market. Yeah, I'm taking a look at the sectors here out of the gate. We are looking like we're down across the board as of right now. Some of the biggest declines, though, coming in the form of communication services. You were talking about this earlier today, communication services in what is still a bizarre time to be an investor. However, some of the biggest declines here this morning out the gate, communication services, technology, and then additionally energy down by about 0.7% right now as well.
Yeah, so let's get back to some more earnings movers. SoFi is one of the companies that reported this morning. And the company topping earnings expectations for the fourth quarter. Revenue was up 58% year over year. Total members up 51%. That was an addition of almost 480,000 in the quarter. The shares are surging by 12%, not just because of all of that, but also because its full year forecast for EBITDA came in ahead of estimates here. So all of that boosting those shares.
Yeah, not GE, excuse me, SoFi. In some of the quarterly new member ads that they had, 4,800,000 there. Total members were up 51%, products up 53% as well. And now here, the company going forward, I think in this environment for the number of consumers that they're going to be looking to add on to their services, this is kind of a big year that people were just looking across any policy that may come about where they had to refinance student loans. And SoFi was a core kind of element of that conversation. Just a larger question of going forward from here, how much of that refinancing still may be part of the SoFi story, at least on a year-over-year comparable basis too.
Right, and this wasn't a perfect quarter, but to Julie's point, the stock is moving, I think, off that very upbeat, optimistic full-year outlook for adjusted operating profits. At the high end, SoFi is modeling for it to almost double year-over-year, despite economic volatility. But in the quarter, they had lower student loan volume and lower home loan originations. So I'm very interested to ask Anthony Noto, CEO of SoFi, more about that when we talk to him in the next hour. Also, personal loan originations up 50% year over year. It's unclear to me if that is a sign of consumer stress, where you just need more money, the inflation's taking bites out of your paycheck, and you need these personal loans. But I'm going to put all those questions to him.
Well, it's also about what kinds of loans, right, and which are the loans that are tend to be more profitable for them. In the statement, he did say there was a growth in high-quality deposits, so that means a lower cost of funding for their loans. So, you have to separate out the two things, right? There's the health of the consumer, and then there's what's good for SoFi. And, yes, you have a lot of overlap in that Venn diagram, but sometimes it matters what the loan mix is for a company like this.
Absolutely. Well, in my quarter note gaffe a moment ago, let's get to GE Healthcare this time. GE Healthcare Technology, ticker symbol GEHC. They reported its first standalone earnings report this morning. Revenue increased over 7% for the fourth quarter. Though profit dipped on an annual basis, the company expects sales to grow between 5% and 7% for the full year. And we had spoken with the CEO of GE Healthcare on the day that they made their debut into the public markets. And on this report, he said that they delivered strong revenue growth in the fourth quarter and full year 2022, saying some of the catalysts were robust end market demand, as well as improved pricing and some of the easing supply chain pressures.
What I don't like on this quarter, generally, I don't have any problems with this per se. Good top-line growth, but operating margins down in the imaging, ultrasound, and pharmaceutical diagnostics segments. The only, really, essentially, this quarter was driven by margin gains in the patient care solutions. So right out of the gate, we're seeing some margin pressure on this newly publicly traded company. I'm sure they will get a lot of questions about that on the earnings call.
Yeah, and they did report preliminary results earlier in the month, so not necessarily seeing as much of a reaction as we would have. The stock has done well since it spun off from GE, so that's interesting, and we'll see, are there sort of lessons for investors to learn here ahead of the eventual separation of the rest of the business as they track GE Healthcare?
All right. Guys, coming up, Yahoo Finance's Jared Blickery is going to break down the latest market action to kick off this trading week. That's coming up. Welcome back to Yahoo Finance Live this morning, everyone. Major averages are in the red across the board. Let's bring in Yahoo Finance's Jared Blickery for just a preview of what we're kind of teeing up for this week and what the markets may be most reactive to.
Well, like many people on this show have been saying this morning, it is our Super Bowl week. We have tons of earnings. We get Apple earnings. We had a bunch of important ones last week. Tesla out of the way, but some other big names as well. And then for me, the Fed is going to be front and center here. Is it going to be one more 25 basis point rate hike? Is it going to be two? I think we're going to get some more color on that. And let's just remember that the Fed doesn't necessarily like to see stocks up. And so if we get into that press conference at 2:30 p.m. on Wednesday afternoon and stocks are flying higher again, well, Powell might just decide to pour cold water over everything. Now, does that mean the rally's over? I don't think so. There's a lot of positive signs here. And whether or not the low, the big low is in or not, I think for some sectors at least, the low is in. So you look at the breakouts. Now, the Russell 2000 broke out last week. So did the Nasdaq above some potential resistance there. The 200-day moving averages have been in play. S&P 500 broke out of that. 4,100 still a level for the SPOOs there that they have to climb out of. But the breakouts have been more than the breakdowns right now. So we got to pay attention to that. And even if we head down in February or March, I think we're going to at least test these lows. But some stocks are just going to be up and away from here. And that's what happens at the beginning of bull markets. People say, well, this has all been a short covering rally. Yes, it has been a short covering rally. But guess what? That's how every single bull market begins. They transition into quality names, but they always begin with a little bit of hesitancy. And, well, it's the market's job to kind of keep people out of the market and making the wrong decisions. So I'm just here to say that I think we've got some plays that we should be paying attention to right now.
And Jared, speaking of breakouts, since mid-January, Bitcoin has been on absolute fire, but looks like we might be getting a breather here.
Yeah, and I was talking to a guest on Friday afternoon about Bitcoin and how levered it is to the Federal Reserve. So I think this is going to be a huge week for Bitcoin because whether stocks are up or down on a Fed announcement, guess what? Bitcoin is usually leading the way up or down by an even larger amount. So if you take the most sensitive risk asset to leverage, which I believe is Bitcoin right now, I think that's going to be the market to watch this week because if at 2:45 or 3 p.m. we're seeing Bitcoin head lower, guess what? Stock's probably going to follow, or if they haven't already, going to be following.
Good point. Jared Blickery, thanks so much. Appreciate it. All right, let's do a little quote of the day to kick off this week. Warren Buffett's Berkshire Hathaway is long been the top shareholder in American Express. The Oracle Omaha owns about 20.3% of the credit card giant. Here's what MX CEO Stephen Squeri recently told me about Buffett. Quote, it's sort of like a good housekeeping seal of approval. Warren and Berkshire are iconic investors and to have him speak about the brand and speak about the company and to speak about the direction that we're going so enthusiastically is important. Straight ahead, the tech earnings Super Bowl nears. We'll sharpen our focus on Apple and see whether the tech giant will let Wall Street down. We'll be right back.
All eyes are on Apple this week as the $2 trillion company releases its first quarter earnings report. Investors and analysts will be looking to see just how much the recent COVID lockdowns in China's iPhone city have disrupted production. Layoffs across the tech sector have rocked an already jittery Wall Street, and while Apple has so far managed to avoid eliminating jobs this year, investors are bracing for a tough report. Wall Street isn't anticipating much to celebrate, as it expects Apple to post lower earnings and revenue than it did a year ago. Apple's stock price has outperformed much of its big tech competitors over the past year. As of January 27th, it's down about 8% in the past 12 months, while Microsoft's share price is down 17% and Google parent Alphabet is down 23%. But despite Apple's performance relative to the broader tech sector, shareholders voted to cut CEO Tim Cook's pay by more than 40% to $49 million this year. A move quickly followed by Google CEO Sundar Pichai, who also announced a pay cut following his company's decision to lay off 12,000 of its employees. And to its credit, Apple has managed to avoid large-scale layoffs, unlike its peers, partly because Apple's headcount grew at a slower pace than other tech giants over the course of the pandemic. According to the Wall Street Journal, Apple's workforce grew by 20% between September 2019 and September 2022. During that same period, Microsoft's headcount increased 53%, Meta's 94%, and Amazon's workforce more than doubled. And that rapid growth, experts say, is what's driving cutbacks across the industry.
We're seeing it across tech. These companies were spending like 1980s rock stars at a pace that was unsustainable.
But the iPhone maker isn't without its own issues. Throughout November and December of 2022, Apple faced significant headwinds from COVID lockdowns and worker protests at manufacturer Foxconn's facility in Zhengzhou, China. The plant, which employs 200,000 workers, produces the bulk of Apple's iPhone 14 Pro and iPhone 14 Pro Max handsets. The iPhone 14 Pro and Pro Max, which start at $999 and $1099, are two of Apple's most important devices. Their steeper prices help boost the average iPhone selling price, driving higher revenue and margins for the tech giant. According to IDC's worldwide quarterly mobile phone tracker, shipments of Apple's iPhone fell 14.9% in the fourth quarter of 2022, down from 85 million units in Q4 2021 to 72.3 million units. But it's not just the iPhone that's faced trouble. During Apple's Q4 earnings call, Apple's CFO Luca Maestri said that Apple expects nearly 10 percentage points of negative year-over-year impact from the strong dollar. What's more, Maestri said he expects Mac revenue to decline substantially year-over-year and expects services revenue to grow but face those currency challenges as well. And while many investors sense trouble for Apple and others in the tech sector, some analysts are seeing signs of optimism in the months ahead.
Well, of course, the PC and smartphone market will be under the spotlight as Apple reports this week. Preliminary data shows a dim picture in store for the fourth quarter of 2022. That's according to researcher IDC. For more on this and the road ahead in 2023 is Ryan Reith. He's IDC Consumer Devices Group VP. Ryan, thanks so much for being here. Let's take smartphones first of all, because it seems like it was a pretty lousy year for smartphone sales in 2023. You guys are looking at an 18.3% drop in the holiday quarter, an 11.3% drop in 2022 overall. What were some of the dynamics driving that, and do you think any of them are going to change this year?
Yeah, good to talk to you again. The dynamics really are that demand has slowed. And I think you could say that for not only the smartphone market, but adjacent markets like PCs, tablets, televisions, et cetera. Inflation obviously has a big impact on this. Clearly, we have a war going on in the world that doesn't help things. And even though China has just changed their policy on the zero COVID situation, it really hasn't changed the consumer sentiment for that market. And let's keep in mind that China, from a consumption standpoint, is the largest market for smartphone consumption. I think it's the second largest market for PCs. So that alone will have a big impact on overall sales. As we look towards this year, I think we're probably not going to see much recovery this year. It'll get a little bit better than where we're at now. I think we still have a little bit further down to go, probably in the next 3 to 4 months. And as we get towards the end of the year, we expect that we'll see some levels of recovery. But really, 2024 is the story around certainly the smartphone market when it starts to come back and grows.
So what should we be expecting in terms of any type of upgrade cycle for devices among consumers?
Well, I mean, if we're talking about phones, I think we'd already seen the real lengthening of the life cycles. I think, we were talking about 4-year life cycles in Europe pre-pandemic. I don't think that too much has changed. If anything, maybe some markets have gone a little bit longer. What I usually say to people when I talk about smartphone replacement cycles is two things. One, the expansion of installment plans, the ability to pay for your phone over the course of 3 years, 4 years in some countries, has expanded not only beyond the US, but it's moved to new channels in parts of Europe. So it gives people the ability to pay for something, over time, which again is not a new concept, but it changes the point of sale a little bit. From a PC standpoint, we're actually expecting some actually slightly condensed refresh cycles, especially on the consumer side compared to pre-pandemic. But right now, I think a lot of that is still sort of questionable as to what that looks like, when we get to 24 and even 25 and beyond.
Ryan, I recently talked with Intel CEO Pat Gelsinger, and he said that the PC correction might extend or might start to improve later this year. How much exposure is Apple's business to the PC continuing to be under pressure in the first half? And do you see them playing a part in that rebound should things improve?
Yeah, so I would say it's exposure to Apple, of course, because the Mac business is not a small business. It's not as big as iPhone, but it's not small. So they're exposed. And like I said, everyone in the PC industry, we're just all going to hear about what they did in the holiday quarter. But I can tell you that the first half of this year, anyone that's in the PC space, whether it's a chip player like Intel or others, or an HP or an Apple, is going to have some hard times. So they're not going to see really positive PC results until a few later this year, but realistically most next year. In terms of how much will Apple play into that, we are actually seeing significant growth for Apple in the PC space, not only based on the results from last year, but we're seeing a lot of traction that they're making, especially since they've moved to their own chips. I mean, they're almost entirely off of Intel now at this stage. So they've got more leverage in terms of, how they price things, where their margins are at. And I think the telling sign is that no one in the PC industry questions the commercial market. I think that's a given that the commercial market is resilient. There's a little bit of setback right now, but next year will be a good year for commercial PCs. And Apple is actually making some traction there, which has been an area where they just really haven't, I don't know if I'd say they haven't focused, but they haven't put a lot of what we've seen manpower towards trying to take what used to be all Intel share. Now Intel is losing some share in the commercial market to not only Apple, but AMD.
Given the stickiness of inflation in services, particularly here, and for Apple, they have services businesses that's a lot of little spends typically for consumers. But is there anything that we can extrapolate from this report about the health of the consumer that we've heard about from banks earlier in this earnings season and airlines even as well? But for many of them, the cycles may be different. For Apple, perhaps that could offer us some type of barometer into the health of the consumer as well. I don't know. I'd love to get your take on that.
Yeah, I think it's a good point. I mean, one of the things that doesn't get talked about as often from both IDC as well as other, whether it's banks or other, market research firms that we, compete with, is we tend to talk about when Apple ships new devices. But what Apple also, especially from the smartphone side, they are the market leader in secondhand shipments that go, that get traded in, that get more often than not get, a new battery, a new screen, maybe a few other cosmetic, improvements, and they get resold back into different industries, usually different countries and so forth. The reason why that's important is because those devices eventually become active. Hand-me-down devices from Apple, even if it's just Wi-Fi to, a child or someone else, those all become active. And that's a benefit for Apple because that's an opportunity to sell services to whoever that user is. So they've got that leg up on the competition. There's no question about that. But at the same time, I mean, they're not immune to, higher cost of goods and people trying to, be a little bit tighter with their wallets. I mean, they sell premium goods. We all know that. That's not a new thing. Even their secondhand goods, when they turn out in different countries, are usually priced higher than a lot of the new smartphones that are being sold in those markets. So, they're facing the same challenges, but they've got other ways, especially where they can continue to drive the services revenue. And we've seen that benefit, for the last, 5-6 years at least now.
All right, well, we'll see how it plays out in the quarter. Ryan Rie, thank you so much. IDC Consumer Device Trackers Group VP. And join us for our After the Call special. Saz and Brad are going to be there following Apple's earnings call this Wednesday. You don't want to miss that. Coming up, Bed Bath & Beyond stores are closing doors. Saz is going to share his take next. Bed Bath & Beyond's making a move to shut down its Harmon brand stores in an effort to conserve cash as the retailer continues on its downward trend. Is the end near for Bed Bath & Beyond? I mean, that's where he finds this take today. Is that really in question at this point? I don't know. Well, I didn't even know. What is Harmon?
Well, you have to question it until it happens, I suppose. So this is a story Yahoo Finance broke late on Friday. So a more accelerated pace of store closings at Bed Bath & Beyond. A couple months ago, they said they would close 150 stores, but now saying or telling Yahoo Finance they will close 87 more stores in addition to that 150. Plus, they're also closing 52 Harmon stores. And Julie, it really is basically a beauty products type of store where you can get beauty products at a good deal. Never was a big focus for the company. It was always seen as a brand that they might cut, and now they're cutting it. Why? Because they have to conserve cash at this critical point in time. So those stores, in fact, closing. We of course reached out to Bed Bath & Beyond for comment. Them, of course, just confirming this, I should say. There you see Julie Strider, Bed Bath & Beyond spokeswoman, telling us and explaining why they're closing these stores. And it really should not be any surprise, Julie and Brad here. You're seeing sales really take a real nosedive at Bed Bath & Beyond over the past couple of decades. You can see it really falling off a map there from 2017 right onto this present day. And now the sales declines are in fact getting worse because the inventory is not being shipped to the stores in a timely manner because of their various credit problems. And if you cannot stock your shelves, you cannot drive sales, you cannot bring in cash flow, and this eventually all just becomes a big black vortex, which brings me to my take. Essentially, right now, Bed Bath & Beyond is known in retail as a zombie retailer. It's there. The stores are there. You can still probably go in there for now and get a towel, get a toothbrush if you need it, or some cups for your house. But by and large, the inventory is unlikely to be current. And chances are, if you go back in a couple of days after your most recent visit, the shelves will probably be bare.
Well, it's a question of the value experience for the consumer, too. If the consumer doesn't think that there is any value in spending time there or putting gas in the tank and spending any of that gas on your trip to Bed Bath & Beyond or even walking into the store, then that just continues on with Bed Bath & Beyond struggling to move the product that they do have in store.
It's a waste of time going there. You want to get all of your shopping done in one day in this still high gas price environment, go to Target, go to Walmart. You can do all of your grocery shopping, and in case of Target, you can have actually just sit in your car and have the groceries brought out to you for free. So it makes a lot more sense to me than going to Bed Bath.
I'm still just really enjoying some zombie sauce.
Graphics, been crushing it. We replaced the Grinch sauce with the zombie sauce.
I like it. It all makes sense. It fits.
All right. Coming up, everyone, there's zombie sauce. Should a recession be the base case? We're going to discuss this with MKM Partners, Michael Darda, coming up next.
Welcome back to Yahoo Finance. I'm Brian Sozzi alongside Julie Hyman and Brad Smith. Investors bracing for a market-moving week headlined by earnings out of Apple and Meta and 3 central bank rate decisions. Right now we're seeing some mixed action ahead of all of these major events. Here's what's on tap this hour. Spending with big tech ahead of earnings from Meta, Alphabet, and Snap. We'll talk to OnePro for a read on the digital ad market. And is it time to buy consumer staple stocks with inflation fears easing? We'll discuss. And Yahoo Finance goes inside the big business of boats. So don't set sail before giving this one a watch. Brad, over to you. I'm setting sail to you over to the Wi-Fi Interactive.
I appreciate that. All right, well, checking in on some of the major averages here. We got some choppy waters here out of the gate for the Dow Jones Industrial Average, which has touched both positive and negative territory. As of right now, it's up by about 0.1%. The Nasdaq Composite, that's still down, not sinking, but lower by about 0.7%. And the S&P 500, that's also lower by about 0.25% right now. And so taking a look at some of the S&P 500 sectors sectors on the day. We've got 11 of them loaded up for you because there's 11 of them in the S&P 500. Energy bringing up the caboose as of right now, or the back of the boat, if you will. It's down by about 1.1%. Okay, I'll stop. XLP, you're seeing that at this point higher by about 0.5%. And then additionally here, roughly split as you can get for the 11 S&P 500 sectors. Technology, just taking a quick gander at that. You're seeing that down by about 0.8% year to date thus far, though. It's been a different story. Still holding on to gains by about 9%. And then just we'll ride out with a look at the Nasdaq as of right now. For some of those mega cap tech names, you've got a lot of red on the screen there, with Microsoft down by about 1.4%, Google about the same on a percentage basis, Apple and Amazon down fractionally here this morning. Also, the headlines versus the bottom line. Stronger than expected GDP figures might be disguising a lack of spending among consumers, but recession may not necessarily be the base case for economists. Joining us with more, we've got Michael Darda, MKM Partners macro strategist and chief economist here. So what is the base case from your perspective, Michael?
Thanks for having me on. I actually think the base case is for a recession. And the reason that I say that is if you look back at historical Fed rate hiking periods, the ones that end up with inverted yield curves that are sustained in chronic weakness in every measure of monetary growth, really we're in record territory on that score. Those are periods that presage recessions without any exceptions. And so I think if one is in the camp that we're going to soft land, you're really making the argument that it's different this time. And as they say, those are the most dangerous 4 years and 4 words in economic forecasting.
And are we going to get a reminder of some of this from the Fed? I mean, obviously the Fed is not going to tell us that we're not having a soft landing, Mike, but are we going to hear from the Fed that maybe they're not going to be as benign as the market is also assuming here?
I think so. They don't really have a reaction function that would pave the way for a soft landing. So if we're listening to what they're saying, they're telling us the intent is to take policy into a restrictive stance and then to hold there for an extended period of time. That means rates above the neutral level, and then they hold them there. So the economy goes to below trend growth, the unemployment rate starts to rise. I mean, that's essentially a recession. They're also telling us that they want to lean against so-called financial conditions, which is, just a coded way of saying the stock market and maybe credit spreads. So, the recent rise in equity markets, if the Fed believes that that is cutting against their policy intent, they'll simply respond by tightening more than they otherwise would. So, I think if you add it all up, we're going to be in a pretty volatile situation this year for risk assets, and recession risk remains quite high in our view.
Michael, do you think the Fed this week will try to jawbone the market a little bit lower, just given how fast the market has come out of the gate this year?
Yeah, I think so. I mean, I think based on everything they've said and done, I think they're going to be really reluctant to sound, quote unquote, dovish in an environment where the equity market is held up well. And, we do have weakness in a lot of data, but they're focused mostly on the labor market, and the job gains, while decelerating, have still been pretty resilient. The unemployment rate hasn't budged yet. We're, sitting here, this is a triple bottom at 3.5%, basically a 50-year low. So unless those things change, I think the Fed is going to just stay the course here. It'll be 25 most likely for the rate hike. Not 50, but they're going to continue to press unless things more visibly start to fall apart.
For investors that have abided by the adage, don't fight the Fed, how can they at least position their portfolio to anticipate the Fed?
Yeah, I think you want to lean against the wind a little bit here. So, the stock market has gone all in on the soft landing story. I mean, we're sitting here at 18 times forward estimates. Even the soft landers, I think, acknowledge that the forward estimates are probably too high. So I would be pretty cautious in here. If the market eventually takes a nosedive, we know with recessions, markets don't bottom out before the recession even starts. Usually it's half to 2/3 of the way through a recession. So if we make new lows at some point this year, closer to 3,200, 3,300 on the S&P, then I think you can, start to add to risk asset positions, but I would not be chasing this market here. I think that's essentially a fool's errand.
Do you think then we are going to make new lows this year? And if so, I mean, without pinning you down to be too precise, which as we know is very difficult, when do you think it's going to happen? First half, second half?
Yeah, I do think we'll make new lows if there's a recession this year, and we do believe there will be. It's interesting thinking about consensus expectations. Obviously, the perception is that the recession's a consensus view. The other two consensus views are that any recession would be short and shallow, but we don't really know that. And number two, that the market would be down and then up this year. Well, maybe it's up and then down, right? So I would just be hesitant to be too bullish on equities here. Unless we're actually making new lows and down in the low 3,000s, then I think you can start to get a bit more bullish on the equity market. But I think we're in dangerous territory here. So people are really getting intoxicated with this China reopening and Europe soft landing story, and that's really pushed a lot of risk assets up at a dangerous time for the business cycle with the inverted yield curve and the negative money supply growth. So if you respect business cycle history and leading indicators, then I think you want to be a bit more cautious here.
Michael Darda, MKM Partners macro strategist and chief economist. Always good to see you. We'll talk to you soon.
Likewise. Thank you.
The GOP-led House is set to vote on a series of pandemic-related bills this week. Meanwhile, the Senate is working toward organizing a resolution to establish rules for the new Congress as it prepares to tackle the debt ceiling. For the latest on Capitol Hill, let's get to Yahoo Finance contributor Kevin Cirilli. Kevin.
Well, big news from House Speaker Kevin McCarthy on CBS Face the Nation over the weekend, in which he essentially said that they want to get to a point where they can raise the debt ceiling. So if you're looking at this from a market analytics standpoint, he's essentially given you the outcome that he wants. Now, the path to get there is where things are going to potentially go haywire, as Republicans are going to continue to advocate for reducing what they describe as wasteful spending. But here's what he said on the Sunday show, quote, "I want to find a reasonable and a responsible way that we can lift the debt ceiling, but take control of this runaway spending. I want to sit down together, work out an agreement that we can move forward to put us on a path to balance, at the same time, not put any of our debt in jeopardy at the same time." He said that to Margaret Brennan. He's meeting with President Biden on Wednesday. Now, we should note we're going to get a lot of economic indicators this week, some of which we're going to get on Wednesday.
Yeah, and let's talk about that, Kevin. We got a busy week on the economic front. We got the Fed meeting. We got jobs data.
Well, as you know, most folks are anticipating that the Fed's going to raise the interest rate hike by 25 basis points, a quarter of a percentage point. And on Friday, we're going to get that jobs data from January. I think most folks are anticipating that the U.S. added about 170 to 190,000 jobs in the month of January. That would tick up the unemployment rate to 3.6% at its current level of 3.5%. Either way, it's this new fight in Washington about whether or not the policy is leading to a recession. We just heard from Mike, whether or not the economy is going to bottom out this year. And it's what Republicans and Democrats are going to be bickering about over the next few months. And, front and center is going to be that debt ceiling debate.
Kevin, while we have you, Secretary of State Antony Blinken has embarked on a trip to Beijing to meet with senior Chinese officials. So what can we expect to come of that?
Well, right now he's going to be in the Middle East, and he's going to be meeting with Israeli Prime Minister Netanyahu and then separately with Palestinian leaders. This comes as tensions have flared in the region, and then he heads to Beijing. And based on the reports, the backdrop to that meeting in Beijing this weekend, early next week, is going to be whether or not the Communist Party of China is helping Russia in Russia's war with Ukraine. Now, the U.S. has really sought to pressure China to distance itself from Russia. But who knows? There's been some reporting by Bloomberg and the likes that some Chinese companies have been aiding and abetting in a non-lethal capacity, but also economically, some Russian companies to skirt some of the sanctions and export controls that the U.S. has put into place. China denies this, but that really does become the starting point for this high-profile meeting between Secretary Blinken and his Chinese counterparts. And dare I say, I could not end this segment talking to you, my friend, without noting how absolutely happy I was to
my good
see
man,
my
yes.
New York colleagues celebrate. I got to say I love New York, and here's why. When the Empire State Building is in Eagles Green,
had to be a fan.
I was blown away. I was heartened, and we're such a humble fan base.
We are.
To be able to
really are.
Dallas Cowboys and then San Francisco And now we're going to the Super Bowl. I mean, could you get any happier on a Monday?
You really couldn't. I had to bring out my Wawa tumbler for today's show as well. Yes.
I have mine over there. Wait, I have the same exact one.
It had to be done.
I feel like I'll get in trouble if I run out of the frame. But,
you can bring it next time. You can bring it next time.
Yes, there are more hits to be done today, Kevin.
Yeah, hey, anytime. Just give me a call.
It is a beautiful day to bleed green indeed, and even the Empire State Building got in on the action. Kevin, I think both of us are probably going to have to bake in a personal or a mental health day, either win or loss, after February 12th.
Hey, we're going to win. You got to manifest this. We're going to win. And no offense to Kansas City, but I think the Philadelphia Eagles are America's team. Am I right or am I right?
Ask Jerry Jones. I believe he thinks the same. Yes. Kevin, thanks so much, man.
Thank you. Yeah, see you guys. Thanks.
All right, moving on from that bromance. Before we head to break, let's spotlight a bearish call on Tesla from JP Morgan analyst Brian Brinkman. Brinkman is reiterating an underweight rating on Tesla, citing disappointment in the company's latest quarterly results and outlook. Says Brinkman, Tesla's softer trend and below consensus adjusted automotive gross margin comes before the impact of large price reductions that will primarily be felt beginning in the first quarter. As such, we view margin trajectory negatively and expect that consensus margin expectations are likely to decline. Brinkman's $120 price target on Tesla assumes 32% downside from current levels. Coming up, Baidu is jumping into AI to take on Microsoft. Julie's back with that and other top headlines next.
Welcome back. Let's get down to business with some other headlines that we are tracking this morning. Chinese internet search giant Baidu is planning to launch an AI chatbot service similar to OpenAI's ChatGPT. That's according to a couple of media reports. They suggest it plans to incorporate chatbot-generated content into its search results. That could come as soon as March. Baidu has been investing heavily in AI technology, including cloud services, chips, and autonomous driving, as it looks to diversify its revenue sources. Currently, chatbots in China tend to focus on social interaction, whereas ChatGPT has made a name for itself in performing professional tasks like essay writing and programming. Toyota has retained its crown as the world's top-selling car maker for the third consecutive year in 2022, widening its lead over Volkswagen even as supply chain disruptions continue to weigh on global automobile production. The Japanese automaker noted that strong demand in Asia helped it boost global production by 5% last year. In 2021, Toyota overtook GM as the best-selling car maker in the United States, a title it had held since the 1930s. And in the latest workforce reduction, medical equipment maker Philips is cutting another 6,000 positions. That's about 8% of its staff. The move, an attempt to reduce expenses as the Amsterdam-based business deals with costly recalls for some of its consumer products. These layoffs, by the way, on top of the already 4,000 cuts that the company has made last year. Half of the latest reductions will happen in 2023. Saz?
All right, advertising technology stocks took a hit across the board last year as economic uncertainties and falling valuations caused many companies to rein in ad spending. That's expected to weigh heavily on Alphabet, which could show up in the company's earnings later on this week. For more on this, let's get to Morningstar's senior equity analyst, Ali Mogharabi. Ali, good to see you here. How bad do you think this impact or this trend will show up in Alphabet's earnings this week?
Well, to a certain extent, yes. I mean, on YouTube, you could see continuing weakness on YouTube. However, I think we think search will be fine for the entire year for 2022 and also, of course, this year. When there's uncertainty from a macro environment, search, a lot more advertising spending may be cut. However, increase in allocation towards search actually does increase because, the users display their intention based on the query that they put in. So the more targeted advertising actually becomes more effective and therefore continues to attract advertisers. So there may be some weakness on the YouTube side, but partially offset on the search side of their advertising. For some businesses that are also reporting this week, advertising is part of the fastest growing segment that they do have. And I'm particularly thinking about Amazon. Amazon does have a quickly growing advertising business over the past several years here. And then you think about Apple and their own kind of throwing of the hat into the ring in advertising as well. How do you expect that to show up within their earnings reports, perhaps? Well, actually, I don't cover those two companies, Amazon and Apple. However, you are right. They continue to gain traction in the digital ad environment. We don't really expect them to actually displace Google as the leader in that market. However, they continue to gain market share in that environment. I mean, Apple certainly has its data that it continues to utilize to make the ads, especially in its app store, more effective. And of course, with Amazon, you've got retail and you've got a lot of brand and also targeted advertising available on that platform. So, my colleagues estimate that they can probably continue to show growth in the ad side of the business.
So, Ali, let's take a step back here because you put out a report earlier in the month where you looked at you have total forecast for ad spend this year. You're looking at growth of 7.9% total, 8.6% in digital specifically. So how would you characterize that? That represents a rebound, right?
Yes, it represents a slight rebound. We don't expect basically a recession in 2023, and that's Morningstar estimates. However, the overall macro uncertainty does slow it down a little bit. I think that the key point that we were making in that report is that we expect continuing deceleration in growth of digital advertising. And there are a couple of reasons. One, as I mentioned earlier, there is macro uncertainty. And then the second is, if you think about it, we're no longer in that early or actually complete, growth stage of digital advertising. We've seen transition from traditional onto digital pretty much nearly complete. By our estimates, we think around 70% of ad spending last year represented digital advertising. So again, there's not that much more transition to take place, and therefore we will see continuing deceleration in digital advertising growth.
So you're looking at some ad tech companies that you track. Given that deceleration, and I know you said that these guys still have some opportunities. Why do they still have opportunities even if things are slowing down?
Well, they have opportunities because some of the larger players are actually facing some pressure, whether it's from a regulatory standpoint, data privacy, and so forth. And and also, there is an increase in first-party data utilization. So a lot of some advertisers actually may consider more independent players, non-walled garden players, as more attractive to do business with. Some of those names that come to mind include Pubmatic, Magnite, the Trade Desk, and LiveRamp. And out of those currently, of course, LiveRamp has performed pretty well since we published, but out of those currently, Pubmatic and Magnite appear to be more attractive for us in our view from an valuation standpoint. We think they do have more upside. So overall, for smaller ad tech players, smaller with respect to Alphabet or Google, of course, we think there are some opportunities, especially in the digital side of the business. When you're talking about connected TV, I think that part of digital advertising is actually growing pretty nicely. And then keep in mind, for example, the lawsuits that were filed by the DOJ and 8 states last week against Google, where there could be a possibility of a forced spinoff. Of course, that remains to be seen. It will take a couple of years for that to take place. But with additional pressure on some of the larger players, such as Google, again, some publishers may actually look more towards some of the other ad tech providers. So those are some of the catalysts that we see.
Yeah, who is the big winner if that is effective, or if there is a forced kind of spinoff that Google or Alphabet has to consider?
Well, that really depends. I mean, there are still a lot of the ad tech market is still fragmented, even with a lot of consolidation that we've seen during the past few years. But we think the ones that could take advantage of it still remain the Trade Desk, Pubmatic, Magnite, and from a data standpoint, an independent one would be LiveRamp.
All right, Morningstar Senior Equity Analyst Ali Moghrabi, thank you so much for joining us here this morning. We appreciate it. Guys, coming up, why consumer staples are struggling so far in 2023. We're going to discuss with Raymond James's Olivia Tong. That's next. The consumer staples sector is facing a difficult start to 2023, down nearly 2% as investors shift away from the space. But our next guest is listing out some key considerations for holding these home and beauty names. Raymond James Managing Director Olivia Tong joins us now. What is the number one consideration that people should be keeping in mind with regard to these names?
Thanks for having me. Appreciate it. A couple of things to think about. The most important things I would say from the top line is the mix between price versus volume. So how many units somebody buys versus the price increases that are coming through. And then on the margin line, on the profit line, it's really around gross margin, because the pressures from higher costs and unfavorable currency movements, which you've heard about, they're lingering for longer. So you'll see a little bit more pressure as we kind of move into the next couple of quarters. And then by the time we get to the second half, you'll see a lot of those cost increases start to lap. So it should get better by second half of the year.
Yeah, Olivia, to your point, I was interested to see in some of the consumer goods companies we've heard from so far, them talking about that the cost increase, that their input cost increases are still happening, right? That they're still trying to cope with that. What should we look for in terms of companies that are still going to have sustainable pricing power as their input costs continue to rise?
Sure, it's a great question. I think a couple of things to think about. First is market shares. So those with the higher market shares, those with a lot of innovation, they can get away with a little bit more pricing, right? They can hold on to a little bit more. People will be willing to pay a little bit more for some improved efficacy or ease of use or convenience or what have you. But you're right, the pressures from these higher costs and unfavorable FX, they have been lingering for a little bit longer. And on the flip side, what you're seeing also is that a lot of these multinational companies, right, there's a little bit of a disconnect between where you produce things versus where you sell them. So that magnifies that impact to some extent.
Olivia, you have outperform ratings on Clorox and Procter & Gamble. Does an investor have to own both of those names? Because I would argue, and I'm sure you know this, both of those stories have been very different the past year. P&G, execution machine, Clorox just has continued to disappoint investors with earnings.
Yes. For Procter, going into earnings season, Procter was our top pick in staples. And it's a very important time here in the sector. As you know, I've been focused on this sector for many years. And in this space, we've seen a huge surge in demand during COVID. Some of this demand stays higher because our habits have changed, hybrid work, et cetera, means more consumption at home. But more importantly, I think for Procter, it's likely one of the earlier ones to see gross margin turn. And we think the fact that it hits multiple price tier points across its most important categories will benefit them through what could be, as you notice, a choppy macro period. Clorox is reporting this week. They're reporting Thursday after the close. This is more of a turnaround story. They had a really challenging time with gross margins last year. So the comp is, as they lap those comps, you should start to see some improvement there.
We've heard from all of these companies in one form or another about price normalization. Is there one that's doing the best with that regard?
I think they're all seeing some increase in price. Of course, they've been putting those through all through last year and at the beginning of this year, and some are still taking more price in order to recoup some of the raw material inflation and currency inflation that you've seen over the last couple of years. For most companies, you are seeing volume degrade as a result of that. That's the elasticity that you see when prices go up. People try to be a little bit more mindful with respect to their purchasing, but they're all seeing some negative from volume and and price accelerate. I think you'll still see this in the case for the next for probably at least another quarter, possibly two. And then hopefully as price starts to anniversary, those price increases that they already took, volume starts to pick up a bit. These are staples categories where you do have to eventually go out and start to consume again.
Olivia, I noticed as I look across your picks here, you have three strong buys in companies that are makeup or sort of personal care companies, Bath & Body Works, Estee Lauder, Ulta. But then you also have them scattered across your other recommendations. In other words, I'm curious what differentiates within personal care and makeup those three names. What are they doing that maybe some of the others aren't?
Sure. Maybe starting with Estee, I think, the main focus this week for earnings is the pace of reopening in China and the consumers' return to travel, whether it's domestically within China to Hainan and other travel destinations, and then also abroad eventually. We think this will be the top focus. Other things that are really interesting with respect to Estee is they acquired Tom Ford a couple of months ago. So learning more about the plans there. That was announced in mid-November, and obviously a very high-end brand. So how that anchors the ultra-luxe portion of Estee's brand portfolio will be an important place to be paying attention to. e.l.f. is another company that we think positively on. It did very well last year, but we think that they have continued momentum. So we think they're one of the best positioned in beauty because they have relatively manageable price points and still a lot of market share opportunity to gain. So quite a bit there. So we do have a bit of a eclectic group, but there are pockets everywhere.
Within that eclectic group, where is the deepest value?
I think the deepest value in a couple of names. Newell Brands is one of them. Now that is a challenge right now because of all the inventory destocking that you've heard at retail. But I think as you get into the back half of the year, this is an inexpensive stock that historically had traded in the 15 to 19 times range pre-acquisition and is now closer to 11 times. So a lot is already embedded into the stock in terms of negativity. So we think that as time progresses, that will get more interesting.
Raymond James Managing Director Olivia Tong, good to see you. Get some, have a fun week. I know it's going to be busy for you and the team. Appreciate it.
Good to see you all.
All right.
Care.
Coming up, the Yahoo Finance team drops anchor on the big business of boats. More on this next. U.S. boat builders climbing aboard the pandemic-fueled boom in outdoors recreation. The industry saw 2022 become the second highest ranked year in marine spending. totaling a whopping $56.7 billion, and they expect the momentum to continue into 2023. This according to the National Marine Manufacturers Association. We caught up with this association and several American boat builders at the New York Boat Show. Here with more is Yahoo Finance's Praz Subramanian. Praz.
That's right, Saz. The New York Boat Show is the oldest boat show in the country, believe it or not, just concluded here in New York. Recreational boating still going strong off the pandemic highs. With demand so strong, boat makers couldn't keep up. The main pain points being a combination of high demand, missing parts, even freak weather all jamming up production. We spoke to the president of Regulator Marine about why it was so hard to ship these boats.
Supply chain was awful. I mean, we couldn't tell our customers when we were going to deliver a boat because we were running out of things. I mean, we ran what we call a waterfall chart. And that waterfall chart was to actually show us when we were going to run out of different components. And, you know, we would look, resin. I mean, who would have thought in the middle of a pandemic you would have an ice storm in Texas that would disrupt a boat process?
Yeah, the resin needed to kind of make those hulls and keep them watertight. Regulator Marine's a big fishing boat brand. Count celebrity chef-like owners Tom Colicchio, who we saw there at the show looking at some Regulator Marine boats. I think he'll be able to get a boat, though, I think.
Yeah, I mean, if they can get the parts they need to build the boat that he wants, I guess. She talked about that ice storm, which obviously was a freak kind of one-off, but are supply chain problems still happening?
Yeah, they're still kind of there here and there. You know, the main supply chain problems are sort of what they're still sawing in the pandemic. They saw in the pandemic, and they're still seeing a bit of those now. We spoke to the NMMA head about that as well, and here's what he told us too.
95% of the boats here are made in America. It's made in America product, a dominant made in America industry that exports. But a lot of the inputs come from offshore and parts that go into the boats while they're manufactured here. Like all the industries, we saw disruptions in the semiconductor area, and if you look at just one engine, you could have 150 semiconductor chips just in that engine.
Yeah, so that old chip crisis is affecting the boating industry too, and it's going to get even worse because they're doing a lot of autonomous and EV type technology in these boats. So it might even be it might even slow down that rollout even more.
Wow, this is really interesting, and you're taking a look at some of the boat builders there on screen. I mean, what was the overall takeaway from the expo, the conference itself?
You know, these guys are fairly positive on the industry going forward. They think that they bought a lot of boats in the pandemic. They still like the boating kind of lifestyle. They're seeing, a lot of these companies are telling me that they have like allocations they're already done for the year in 2023, even 2024. So the boating industry is still pretty strong right now. So they're fairly positive on the industry, despite the fact that we have a lot of these macro headwinds coming up potentially.
What's the vibe at the boat show? I've been to the New York Car Show, right? And you really get a broad swath of different people. I've been with my kids before. Like, what's the crowd like at the boat show? Were there a lot of people there? What was it like?
We went on the second day, which is Thursday, and over the weekend it's a much bigger crowd, but a lot of dealers, a lot of kind of passionate people like Tom Colicchio walking around. You know, a lot of big people who are the fisherman industry, huge. People, they're very passionate. They want new boats. They want these nice boats to go out. They're very competitive. They go out all year round, right? Not just the summer. So for the fishing industry or the boating industry, they love that kind of subset. But also people like you or I who maybe live by the water. Saz.
How do you get these assignments, Praz? I've been watching this. I mean, this is plush stuff, my man.
Yeah, you know, a little afternoon action at the Javits Center.
Just because he's at the Javits Center doesn't mean he's buying the boat.
That's true. Well, he's not telling us, but he may be.
I've only driven a pontoon boat. Okay, so that's the extent of my captaining.
I mean, I saw Dougie Fresh perform once at the auto show. I wonder who the performer is, if anybody performs at the boat show.
Probably Christopher Cross, someone like that.
That would be very appropriate.
You hear a lot of yacht rock.
Or maybe
that's what people play, right?
Leonardo DiCaprio. He was on the Titanic, right?
A little violin.
Need a different boat show.
Margaritaville pop-up, I feel like would be good.
A lot of Jimmy Buffett.
Yes,
Yeah.
I'm sure. All right, thanks, Praz. Coming up, how Amazon may have fumbled its NFL viewership in its first season as an exclusive broadcaster. We'll have the details next. Even though the session's just a little over an hour old, we have seen a lot of movement already, with the Nasdaq kind of making a feint to the upside here before coming back down. And it's now at the lows of the session, up down about 1.7%. We have seen similar action for the S&P 500, which is now down almost 0.9%. The Dow was actually in the green for a little while, and now it's going back lower as well. Let's take a look at the components here and see what is going on when we take a look in the S&P in particular. Some of the groups that we earlier talked about as the best performers on the year are now rolling over. So we have seen big increases in the XLK, that is the Information Technology Index. Communication Services is the best performer on the year, so it's down 1.5% today. And then consumer discretionary is also taking a hit today. Something else I wanted to highlight is what we are seeing in the China ADRs that trade here in the United States. Alibaba leading the declines there, down by 5.6%. And you see a good amount of dark red on the screen. Pinduoduo down 7%, JD.com down 5.5%. There doesn't seem to be really a specific catalyst necessarily here with what we are watching, but many of these stocks have had a big year thus far. So it could just be some selling after the big gains. We've seen Alibaba, for example, up 26%, Pinduoduo up 19%, JD up 7%. So now seeing a reversal of some of those gains. Similar phenomenon, kind of the back and forth that we are seeing with Bitcoin, which is up 39% year to date. And then if you go back to the intraday, we are seeing a pullback here. So sort of to the upside and to the downside here, we are seeing some reversals in today's session. Well, switching gears, Super Bowl 57 just 2 weeks away, with the Kansas City Chiefs set to play the Philadelphia Eagles, to Brad's delight. The event is often one of the biggest draws to national television, but with millions of households cutting the cord and competition among streaming providers heating up, viewership is expected to play out differently in 2023. Yahoo Finance's Ali Canal has the details. Hey, Ali. So what have we seen so far in terms of viewership trends?
Well, number one, Brad, I am also a huge Eagles fan, so go Birds. But yes, there has been an acceleration in cord cutting. There has been this decline in linear television overall. But when we talk about sports, the numbers don't lie here, especially when we look at those traditional cable operators, those traditional cable networks. According to Nielsen data cited by those networks, we actually see that there's been an uptick in NFL viewership over this past year. NBC, which airs those primetime games, averaging around 19.9 million viewers per week. CBS and Fox in those early afternoon games, 18.5 and 19.4 million respectively. And then for those later 4 p.m. games, CBS and Fox averaging each about 24 million. And, you know, just to put that all in perspective, that's NBC's highest NFL viewership since 2019, top viewership for CBS since 2015, and top viewership for Fox since 2016. So folks are clearly still tuning in. And then if you compare that to Amazon Prime, which we know signed that 11-year, $13 billion deal with the NFL for Thursday Night Football, along with ESPN, which airs the NFL's Monday night games on cable, NBC, CBS, and Fox still reign supreme. Amazon's Thursday night games averaging around $9.6 million viewers, I should say, weekly. And then ESPN Monday night, 13.4 million viewers. And those numbers, they're both down compared to 2021, with Thursday Night Football slipping 41% year over year. And that's really the concern. What do we make with those Amazon Prime numbers? We saw a lot of success in the beginning of the season, the most signups for Prime for that first week of Thursday Night Football. But then we saw that significant drop off. And there is this uncertainty right now in the current landscape with media, with streaming. And you do have to wonder if the NFL is alienating some of those fans by signing these exclusive streaming packages. But at the same time, I think it's clear that they want to diversify their broadcasts a little bit. They signed that deal with YouTube as well. So I think it's a wait and see approach, and Amazon clearly emphasizing that this is a long-term play for the company and they're going to learn and grow over time.
Yeah, they put that in their 2021 announcement, saying that they were trying to broaden the league's digital football to a larger audience. And that's when we really got that announcement of many of the network partnerships for Amazon, CBS, ABC, and ESPN, Fox, and NBC. But all of them have big streaming numbers that they're trying to prop up as well. So what right do they have, or at least what strategy, I should say, are they trying to implement within getting more streaming viewers for some of the football that they've been able to license out.
Yeah, and if you think about sports, that's been a big driver of M&A. It's been a big driver overall. If you look at the top 100 programs, 82 out of the 100 are specifically NFL, and then some 94 out of the 100 are sports related. And I think that's why you're seeing these tech giants dabble in sports. It's why you're seeing streaming giants like Netflix explore different opportunities within sports. But you have to remember that with broadcast, with these sports partnerships, you also have promises that you make to advertisers. And Amazon's viewership fell short of roughly 12 million people that it had promised advertisers that they would reach. So what is the impact of that? What's the fallout for that? I do think the NFL, it's been looking for a refresh. It's been looking to attract those younger users. A lot of those younger users are on those streaming platforms, but it's going to take time to really figure out what that means and what this data ultimately means. We're still early days. We're still early in a lot of these contracts, these partnerships. So it's wait and see right now.
Were you the one that changed the lights green on the Empire State Building?
I'm not. I will neither confirm nor deny, but I loved it.
Smart. Your lawyers didn't say you had to answer that question. Ali Canal, thanks so much for joining us, breaking this down.
Go Birds.
Guys, coming up, your Amazon grocery delivery now going to come at a new cost. We're going to share the details of the price hike. That's next. If you hear the music, you know what time it is. Time for Cup of Time. 3 stories, 1 minute each. We're going to start with this today. Amazon Prime members will now have to pay a little more for grocery deliveries. The tech giant announced that starting February 28th, Amazon Prime members will have to pay as much as $9.95 in delivery fees for orders under $150. That can start to add up if you're placing multiple grocery delivery orders over the course of a week.
Well, it's a big jump, too, because the minimum used to be $35 for you to get free orders. Okay. Now you're going up to $150. I mean, it's not too hard to, as someone who has a very hungry household, it's not too hard to get up to $150, especially at a Whole Foods, but still, it's big change.
I think the read-through here is that, there is likely another membership fee hike for Prime members coming. And maybe this is them floating a trial balloon out there that is Amazon to see if the consumers are willing to ultimately pay higher prices. What is it, $140 a year, I think?
139, yes, I think that's what it is. I mean, listen, it's expensive to do grocery delivery. The economics of that are challenging. You have the people who are shopping in the stores who you have to pay. You have then the drivers you have to pay.
We've been spoiled.
So,
We've been spoiled if you this food delivery. I mean, $35 threshold for a shipment. I mean, that's been pretty good. That's
Where's
been
the
a good deal.
autonomous delivery? That's what Amazon had told us was the future, and I'm still expecting
Future's
to
not
see
here
more
yet for
robots rolling around autonomously.
I bet it won't be
delivering
any
groceries.
cheaper, though.
No, probably won't be more expensive. Shares of Adani Group companies are continuing to face backlash after a report from Hindenburg Research accused the company of an accounting fraud scheme. The short seller is doubling down on its take despite Adani's 413-page response disputing the claim. And I just exchanged a text this morning with the Hindenburg folks. Nathan Anderson, his team does really top work here, and I would quantify his work on Adani as very much fitting in that. Adani noting to him, they called him the Madoff of Manhattan. At the bottom of Hindenburg's research report, says this, quote, Adani seems unaware that Madoff lived in Manhattan, so he was quite literally his own Madoff of Manhattan. But again, the words are starting to get hot and heated here, and as you would expect, I mean, the third richest man in the world, his wealth is going up in smoke.
Yeah, I mean, we now have seen more than $60 billion in value wiped off of his various companies here that are under this umbrella. One of the other things that Adani came back with in that more than 400-page report was sort of painting this as an attack on India. And then in Hindenburg's response, they called out sort of trying to fan nationalist fervor in that response. It doesn't seem to be working.
Yeah, according to the Bloomberg Billionaires Index, $30 billion of his own net worth, roughly, also lost over the period of time.
And finally, Unilever is shaking up its leadership, announcing that current CEO Alan Jope will be replaced by Hein Schumacher. He's the current CEO of a Netherlands-based dairy and nutrition cooperative. That change is going to take effect on July 1st. And Saz, I know you cover this very closely. And, you know, this is amidst some activist pressure on Unilever, right?
Yeah, we talked to Alan Jope at the World Economic Forum, Julie. I think he's handing this incoming CEO a real strong playbook of what to do. Now, they just had an investor day a couple months ago. They laid out really what appears to be a strong, more focused plan, which is good. But falling on the new CEO's shoulders, does this company have to be split up? Does he have to split food away from consumer products? And I think that's going to be a decision he's going to have to make probably within the first year of his tenure.
And what type of pricing changes, given the conversation we were just having a few moments ago regarding some of the volume declines as prices have needed to factor in some of the more costly inputs that businesses like Unilever, like many of the CPG companies, have to also just pass on to the consumer. What is the pricing strategy that an incoming CEO will also consider or implement?
Yeah, I also really wonder, Unilever has really coupled itself with stakeholder capitalism as a B corporation. Will this new CEO continue in that vein? Well, that does it for us on this Monday morning. If you take a look at markets here, we were near the lows of the session just a little bit ago. Not quite there anymore. We bounced up off the lows a little bit. Rochelle Akufo is going to have you for the next hour of trading, and Saz is going to be back. He's going to have a conversation with SoFi CEO Anthony Noto. Stick around for that.
Welcome to Yahoo Finance Live. It's 11 a.m. on the East Coast and 8 a.m. on the West. I'm Rochelle Akufo. Here's a look at what I'm watching this morning. A big few days. Stocks start the week lower as the Fed looms, and there's no shortage of catalysts. We take a closer look at risk assets like Bitcoin and give you a sense of what strategy your financial advisor might suggest. And wheels in motion. Ford follows Tesla's lead and slashes prices on its Mustang Mach-E. We look at the impact on the wider sector, and we'll talk global competition as Toyota is yet again crowned the world's top seller. Can anyone else catch up? And the battle over student debt cancellation drags on. But what could happen if the Supreme Court rules against President Biden's forgiveness plans? SoFi is uniquely placed in the space. We'll ask CEO Anthony Noto for his take. But first, let's take a look at how the major indices are faring an hour and a half into the trading day. As we've said, their market's searching for some direction here ahead of a big week of data coming out. The Dow there relatively flat, though down about 1/10%. The S&P 500 there down 29 points on the day. And the tech-heavy Nasdaq there having the biggest drag there, down 1.5%. All right, let's shift gears and take a look at the Treasury market, of course, most impacted by what we will hear from the Fed this week. The 5-year up slightly there at 1.6%. The 10-year, most closely tied to that Fed decision, up just slightly there, about 0.68%. The 30-year, the longer-term yields, up about 0.25%. Well, fears of Bitcoin's price action pull into view. The digital asset's long-term trend hangs in the balance as the Fed's next rate hike decision fast approaches. Here with more on what to watch for Bitcoin is Yahoo Finance's own Jared Blickery. Hey, Jared.
Hey there. It is all about the Fed. And, well, this is what's happened over the last 24 hours. Let's get a quick look of what happened over the weekend. And why did I say all about the Fed when we're talking crypto? That is because crypto is very levered to the Fed's balance sheet and to its money printing operations, to monetary policy in general. So here's Bitcoin up a whopping 0.5% over the last 3 days. But here's what it's done year to date. Now up almost 40%. We haven't seen a January like this since way back in 2013. And let me just show you what was happening back then. So this is a max chart. This goes back to what, 2009? Now back in 2013, you're not going to be able to see the line. We did have a huge run up for about 4 months, I believe. And is it going to look anything like this? Well, what I want to focus on is this huge peak that we had back here in 2017. That was a high of 20,000. Now they say markets have price history, price memory, and we can see that playing out. In fact, we dipped below 20,000. You might call this potentially a false breakdown. Why false? Because if the direction is now up, that would be a little bit of a scare to the downside that we often see in technical trading here. Now, the point is we could be on the upswing here, but we have some obstacles. Now, let me show you a Yahoo Finance chart. I pulled this from our website, a little bit of copy and paste here. And what I wanted to show here, this is a free indicator called volume profile. This tells you all the volume that has been transacted at a given price level. So this goes back 2 years. This is the top here at almost 79,000. And right here, this is 30,000. So this line right here is a huge area. And you can see indeed that most of the volume is concentrated between 30 and 60,000. Now, we're also coming off a very, very strong base. The fact that this line right here at 20,000 is this big probably means that that's a very good support. And we would not want to see that violated should prices come down again. Suffice to say, once we get above 25,000, should be smooth sailing to 30,000, but that's where the rubber meets the road. So this Wednesday with the Fed is going to be very important. As I said, these crypto assets tend to lead the Fed, tend to lead stocks and bonds more than anything else. It is what it is. So on Fed Day at 2:30 p.m. when Chair Powell takes the lectern, I'm going to be watching Bitcoin to see where we might be ending the day with stocks.
We'll have to see that. That's interesting that that's becoming now an indicator when we think of the Fed, given where Bitcoin started. Great stuff. Jared Blickery there for us. Right, well, while long-term sentiment on crypto is bullish among financial advisors, limited access and regulatory uncertainty concerns remain a pain point for greater crypto adoption in portfolios. Here with more of the details is Matt Hogan, Bitwise Asset Management CIO. Good to see you, Matt. So obviously a lot of retail investors had a lot of concerns with the FTX fallout and everything else. But in terms of what you're seeing financial advisors, what they're hearing from clients, what's standing out to you right now?
Yeah, the incredible thing, we just finished a survey of financial advisors and they are hearing from clients. That's the incredible thing. You know, last year was such a massive pullback in the crypto markets. but we heard that 90% of financial advisors fielded questions from clients about crypto. And the number one question was, should I invest? I think investors have seen this bull and bear market in crypto in the past, and they know that each time crypto's pulled back significantly, it's gone on to recover and move to all-time highs. So financial advisors are hearing from clients, should we be exposed to that? And an increasing number of them are saying yes.
And then, Matt, when we translate that interest into what we actually see in client portfolios, I mean, it is a low number, 15% allocating in client accounts, and you attribute that mostly to access, as well as some, perhaps, a bit of uncertainty as people try and figure out what's going to happen with this crypto environment.
That's exactly right. More than half of the financial advisors we surveyed said they could not get exposure to crypto in client accounts, maybe because they work for a firm that blocks it or there are regulatory hurdles for them. Among financial advisors who can allocate, more than 50% do. And the reason is simple. Crypto is an incredible asymmetric return asset that you can put in portfolios in small amounts and have a large impact on that portfolio. It is the case that access is improving. The number of national account platforms that Bitwise products are on tripled over the last year. And increasingly, advisors are looking at things like crypto equity ETFs as an easier on-ramp into the space. So access remains a major gating factor, but it's improving quickly. And that's going to bring the assets that financial advisors manage into the crypto space in the next year, 2 years, and 3 years.
So Matt, then for those who do have access but are still choosing not to invest, what are the biggest headwinds for them? What's giving them the most pause?
Yeah, it's funny. We've asked that question 5 years in a row, and the answer has been the same: regulation. Advisors want more regulation of the crypto space so they feel more secure, so their client assets are more secure. And that's actually an interesting insight for viewers. There are a lot of people out there who think the headlines around regulation in crypto are scary. Like every time the White House puts out a report or Congress takes steps, that's going to be a negative for the crypto market. That's actually not right. More regulation is going to be a positive for the crypto market because it's going to bring the professional investing class into the market. And remember, financial advisors and institutions have about 4 times as much assets as retail investors. So this is a huge wave of money. When you see regulatory headlines around crypto, bias towards thinking that's a good thing and not a bad thing, and you'll be able to interpret how the market responds.
And Matt, we know that one of the reasons that the government doesn't want to see crypto and things like 401k and other things is because really that explanation of risk, really understanding, because there's a lot of people out there with a lot of high valuations for where Bitcoin could go long term. A lot of that's still unproven at the moment. So then how soon do you think this will be a really great opportunity for financial advisors when you do still have so many policy headwinds in between?
Yeah, look, I think it's an incredible business development opportunity for financial advisors today, because right now their clients are doing it on their own. Remember, Coinbase has 100 million retail accounts. When advisors ask clients if they're investing on their own, they said yes. Those clients would do better if they brought the assets in-house with the advisors so they could be managed in a professional fashion. The percentage of advisors who allocate to crypto and client accounts has been going up for the past 5 years. When we started this survey, only 4% of financial advisors had allocations. Today it's 15%. I think 4 years from now, it will be over 50%. So it's coming, regulation is coming, and advisors need to educate themselves around the space to stay ahead of this trend.
But Matt, we know that a lot of people switch to some of these hard wallets. They don't want to have another person managing their crypto. What's the selling point then for having a financial advisor versus keeping everything on your own hard wallet?
Yeah, I think there are valid instances of both. If you have incredible security hygiene as an individual, and you're a really strong sort of institutionally oriented investor, that you'll not panic and sell when the market goes down, that you'll rebalance your portfolio, then absolutely do it on your own. But if you're not, if you're like 90% of Americans who don't have, days and weeks to dedicate to this yourself, you're probably better with a financial advisor surveying the market, finding the best product, deciding if you want to be in crypto equities or crypto assets like Bitcoin, and then using crypto in a portfolio the same way you use stocks and bonds and other assets. You don't need to think of it outside those bands. So sure, some investors will do well doing it themselves if they have that incredible security hygiene. But if not, trust an advisor to find a regulated partner who establishes funds in the market's been doing it for a number of years, and go in that direction. They're both valid paths.
And Matt, it does seem people are really playing the long game here. I mean, 60% of the clients surveyed bullish on Bitcoin going up at that 5-year point. And we are expecting a halving for Bitcoin to come in 2024. What do you think is going to be the triggering event for a bull run in Bitcoin?
Yeah, I actually think we're already in it. If you look at the returns this year, we're up more than 40%. I think we'll end the year higher than we are today. Crypto has historically moved in 4-year cycles with 3 up years and 1 pullback year. We saw that again. 2022 was the pullback year, but there's a lot of exciting technological development. So I think we're in the new bull cycle. But when does it go back to all-time highs? That will take regulatory progress. It will take the passage of time. It won't be easy. I suspect it'll be volatile. But as you said, a large number of advisors think it's going in that direction over the next 5 years. I think that's a good time window. We will get there. We're already starting on that bullish path, and you can expect that to continue.
We'll definitely check back with you, see where Bitcoin goes. Obviously, anything can happen, and black swan events like COVID or what happens in the Ukraine and Russia can certainly throw a wrench into things. A big thank you for joining me this morning. Matt Hogan there, Bitwise Asset Management CIO. Thanks so much. All right, coming up, combing through the words. It's that time again. Wall Street is preparing for the Federal Reserve's decision later this week. We'll dive into what to expect from the FOMC. Stay tuned. Markets anticipating the Fed's next moves, and so far they've given no hints they'll let up on the fight against inflation. Here with a summary of what to watch, Yahoo Finance's Jennifer Schonberger. Hey Jen, a big week.
Good morning to you. That's right. A big week indeed. The Federal Reserve kicking off its first policy meeting of the year Tuesday, where it is widely expected to slow down the pace of rate hikes while looking at how much further it needs to raise rates ultimately this year after 3 months of slowing inflation. Here are 3 things to watch. Number 1, a 25 basis point rate hike. A chorus of Fed officials have signaled a quarter-point rate hike at this meeting, which would mark a further slowdown in pace from the 0.5 percentage point hike seen in December. Markets are pricing in a nearly 100% chance that this happens. That would bring the policy rate to a range of 4.5 to 4 3/4, marking the highest level since October 2007. The Fed wants to slow down the pace of rate hikes to assess the impact on the economy so far and see how much higher they need to raise the policy rate to continue bringing down inflation. Number 2, how much further will the policy rate rise, and when could the Fed pause? Read the Fed's statement closely and see whether they leave in language that, quote, ongoing increases in rates, emphasis on plural there, will be required. Also, listen to comments from Fed Chair Powell during the press conference, since there won't be any new interest rate projections this meeting. Most Fed officials estimated in December that the policy rate would need to rise to a peak between 5 and 5 1/4, implying about 2 more quarter-point increases. Number 3, what does Fed Chair Powell say about financial conditions? The Fed has said any easing in financial conditions will make it harder for them to do their job and could require further rate hikes. If you look at the yield on the 10-year Treasury and the level on the S&P, they're about roughly where they were mid-December, perhaps a hair higher when the Fed met last. Some officials have talked about the potential to raise rates even after the Fed pauses if financial conditions loosen or inflation remains high. Watch to see whether Fed Chair Powell will say the same thing. Now, Rochelle, I just want to point out one other major data point that Fed officials are closely watching tomorrow morning is the employment cost index. This is important because it is an indicator of wage growth, which they believe is feeding into inflation. Now, depending on where that number comes in, it probably won't change the calculus for a 25 basis point rate hike, but could have implications for how they see things going forward. Back to you.
Indeed, a lot for them to pass through with every word that Fed Chair Powell says. Jen Schonberger, thank you so much. Well, the Fed isn't the only thing weighing on markets. The ongoing debate about the debt ceiling also has the potential to dampen sentiment. This, alongside recent economic data, is leading some economists to say there won't be a soft landing for the US, but also that the recession won't be as dire as some say. Joining us with more is Elliot Hentoff, Head of Policy Research at State Street Global Advisors. Good to see you, Elliot. Obviously, a big stew of things. We are expecting some volatility ahead of this debt ceiling standoff, though I don't think anyone's actually expecting a default. But when you add that with already uncertainty about when the Fed will pivot and perhaps bond markets pricing in a little too much optimism, how should investors be looking at this period?
Yes, I think we are in for an unfortunate alignment of circumstances with the debt ceiling crisis going to emerge when the macro data really takes a step south. So the bond market, as you pointed out, has been very optimistic. I just want to remind viewers here that last summer or last spring, the bond market was forecasting the first rate cut now. Yes, for February of 2023. And obviously, we're very far away from that. So I would caution viewers again to look at the bond market's assumptions and rethink whether indeed they think inflation and growth comes down at a pace that gives political cover to the Fed to undo some of the rate hikes they've done over the past year. Final word on the debt ceiling. What did I want to talk about? A lot of the macro data, yes, U.S. economic data has been pretty decent so far, particularly the fourth quarter of last year. But when you look at a lot of other indicators that are forward-looking, it suggests we're about to head for a much stronger slowdown than anticipated.
And obviously, there's a lot of noise in the market with every data point that comes out. Which factors are you focusing on when you're trying to determine the path, not just that the Fed might take, but perhaps the sort of recession that might be ahead as well?
Well, there's no great mystery here. It's the usual stuff. I would say some of us economists look a little bit more at indicators that have had, let's say, a better track record in terms of forecasting recession. So if you look at jobs numbers, for instance, the continuing job claims have had a much better predictive power in terms of future economic cycles. And there, for instance, we hit a critical threshold towards the end of the last year, which is that continuing job claims are up only about 14% off their lows. Now, that may not sound like much, particularly because in absolute numbers, they're still pretty low. But whenever those numbers have gone up by that extent, that has usually brought a recession, or put it this way, every recession has been preceded by that type of jump within the 6 to 9 months beforehand. So again, that's just one example on the jobs front. If you look at inflation, if you disentangle the inflation numbers, you see that particularly wage-related inflation is still very sticky. Services-related inflation, very sticky. It does not look like the whole disinflation wave that is supposed to basically precede the rate cuts is really taking hold in critical areas of the inflation metrics.
And we know, of course, the Fed will be keeping an eye on that employment data. But as we look at other central banks, what we're seeing, the ECB also coming out this week, as well as the Bank of England, how are those expectations differing? Obviously, they have different pressures as a result of what they saw with their energy crunch.
Well, they have divine intervention on in support of their actions. What do I mean? Obviously, one thing we were all worried about was the nature of the winter in Europe, and that obviously has passed, at least from an economic point of view, passed incredibly well above expectations. And so basically, it's not an equal distribution curve of outcome.
We seem to have lost him there, but a big thank you there to Elliot Hentove, their head of policy research at State Street Global Advisors. Thank you for joining me. All right, coming up, watching the bottom line. Is Spotify finally moving towards sustainable profits? The streaming giant set to report results tomorrow. We'll preview what to expect next. Spotify set to report fourth quarter earnings on Tuesday before the opening bell. Yahoo finance reporter Ali Kanal is here with what we can expect from the music streamer. Ali, what are you expecting?
Hi, Rochelle. And Spotify had a really rough 2022 with the stock losing more than 2/3 of its value. And if you look at the stock performance since we saw that record high in February 2021, the stock is still down about 65%. So investors are really going to be focused on this earnings report to see if there are any improvements when it comes to profitability along with gross margins. Now, here are top and bottom line expectations, and reminder that Spotify does report in earnings. Estimates for revenue coming in at roughly 3.2 billion euro on an adjusted loss of roughly 130 a share. Total monthly active users, that's expected to tick higher to reach 479 million. On a premium subscriber basis, those numbers expected to grow 7 million in the quarter to reach 202 million, with ad-supported users estimated to come in at about 287 million. That would be a 14 million jump compared to Q3. But again, I think the main focus here is going to be on gross margins. Those numbers did disappoint in the third quarter, sending shares down about 13% following the results. When it comes to Q4, those numbers are pretty muted in comparison to Q3. Current estimates calling for around 24.5%. So anything less than that, you will likely see a major sell-off. And really, this is a narrative that Spotify has been grappling with for quite some time. Really solid top-line growth, really solid subscriber numbers, but those medium to long-term investments, especially when we think about podcasting, that's just been hammering the bottom line. And investors, they don't have the patience for it anymore.
I mean, when you think about how podcasting especially blew up during the pandemic when people were under lockdown, different story now. So, I mean, will Spotify be forced to pivot that growth at all cost strategy in order to reach those profitability targets?
That certainly seems to be the vibe over these past few weeks heading into earnings, especially after last week when we saw Spotify lay off 6% of its workforce, restructure the business. Dawn Ostroff, who led that podcast division, she will now be stepping down. And it seems like Spotify is finally starting to understand that it's very expensive to create original programming. It's very expensive to lure these high-profile celebrities for podcasting. I mean, if you look at some of these deals, we're talking hundreds of millions of dollars for deals with Joe Rogan, Kim Kardashian. So there needs to be a better way. Spotify has been developing advertising technology for audio so it can take advantage of those ad dollars. The company did reiterate to Yahoo Finance that 2022 was that peak investment year, and that in 2023, you'll start to see incremental improvements on profitability, on operating income. But this is going to be a long-term effort, and investors really, really want to see improvements. So I think we're going to see a pivot in this podcasting strategy. And I also think, I know subscribers don't want to hear this, but I do think we could see some price hikes, especially with YouTube Premium and Apple Music recently hiking prices as well. So we'll see if we get any of those announcements on the earnings call tomorrow morning for Spotify Q4 results.
That does seem to be that trend, seeing those incremental increases for subscribers. Ali Kanal, thank you for that update. All right, time now for our trending ticker. Shares of Alibaba Group under pressure after reports surfaced that the China-based company is planning to move its headquarters out of the country to Singapore. Now, the group has since denied the reporting and stated that its headquarters would remain in the east of mainland China, adding that the Singapore facility would house regional operations. The stock there, though, down almost 5%. All right, coming up, Ford follows Tesla's lead and slashes prices on its Mustang Mach-E. We look at the impact on the wider sector as the battle over EV dominance takes yet another turn. We discuss next. Ford's new EV supply chain is coming online, and the company is ramping up production of its Mustang Mach-E to help reduce customer wait times and take advantage of streamlined costs to reduce prices across the board. Now, the move prices Ford's Mach-E more competitively against Tesla, which recently cut prices as well. Well, for more on the EV market, let's go to Yahoo Finance's Pras Subramanian. Good for consumers. I know they like to hear these price cuts coming in.
Everyone loves price cuts, but Rochelle, really the big news here is this is all in response to Tesla cutting prices of that Mustang Mach-E here. You know, from as little as $600 to $6,000 for certain models. You now have 4 models below that very, very, very important $55,000 IRA price tax cap that you need to get that big tax credit. So that's a huge deal for Ford there. Ford said in a statement, though, we're not going to cede ground to anyone. A very strong statement there because they're basically talking about Tesla there, right? So strong words, but will it be enough to sort of compete? And like you mentioned, Ford also boost production. They didn't say by how much, but I want to note that they sold around 40,000 Mach-E's last year. So I imagine looking to at least double that capacity by 2023.
And, you know, people are always looking for things like new models. We haven't seen any new models from Tesla in a while. But then when you look at the prices, some of it might be apples to oranges, depending on how different they are. But how do the prices for the new Mach-E compare to Tesla's vehicles?
So after the price cuts, the most compelling sort of trim here for the Ford Mustang Mach-E is it's called the E all-wheel drive premium model. That costs around $54,000. That compares very favorably to the standard Model Y long range, which is around the same price. Both are all-wheel drive. Both will qualify for that $55,000 price tax credit. So that's probably where the battleground is for Ford versus Tesla. But Tesla has a secret weapon in the sense that their 7-seat trim versions qualify for an $80,000 price cap for the IRA. So if you add that $4,000 7-seater trim selection for your Model Y, you get that higher price cap for the tax cuts. And that means you can buy more expensive versions of Tesla's cars, which are then better for Tesla from a margin point of view.
So definitely keeping that in mind, sort of doing the math here to work out what ends up better for you and your tax breaks. Also want to talk Toyota, still selling more cars than anyone else. What's the story there?
Yeah, you know, they eked out a win over Volkswagen now. I think it's the third year in a row they've been the number one car seller in the world. You know, it's sort of like it's a good thing to kind of have as a feather in your hat, but when we're talking about margin shrinking, component crises, it's actually hard to sort of execute and take that crown away. So, you know, Volkswagen is sort of coming on their heels, and Toyota had to they've changed up their CEO. They switched over CEOs now because they're kind of behind the game in terms of EVs. They haven't been selling them in EVs at all. But they sell a lot of hybrids, which are very competitive, very, very in demand for consumers still. So in a good spot for Toyota here, but I think that down the line, I don't think they really want to be that number one model, number one builder, because it's too much pressure there to actually perform when you're trying to actually boost prices and boost margins in this kind of changing world in autos.
It's changing fast after they took the crown from GM. Be interesting to see what happens when they do really make that push into the EV space. Pras Subramanian, thanks so much. All right, well, while inflation is still up over 11% for at-home food and over 8% for away-from-home food, consumers have a few bright spots to focus on for their Super Bowl parties this year. Wells Fargo Chief Agricultural Economist Michael Swanson joins us now alongside Yahoo Finance's Brooke De Palma. So a big welcome to you. A lot of people wondering, chicken wing prices going down. When you look at poultry prices, a different story there. Obviously, we know about the avian flu, but break down the differences in the type of flocks and how that's affecting poultry prices versus egg prices.
Well, there are two different supply chains. You know, the egg producers have their birds, they're in the barns on a constant basis. And the ones that are producing the chicken wings, the chicken tenders, the ones we love for the chicken sandwiches out there, are a different flock. They rotate very quickly, so they have not been hit by that avian influenza as much. And so it's really been a completely night and day type operation.
And let's just talk about quickly the price of those chicken wings. According to the report out this morning, they're down 22%. What would you say is the largest driver of that decrease in price?
Well, you know, there's a lot of opportunity to make money at the prices last year. And so we saw supply grow. We saw the cold storage, the frozen supplies really ramp up in anticipation. And so that extra supply has taken a lot of that fear premium out of the market. Plus, transportation is a big deal. We've seen freight rates across the country drop. You know, some of the softer economic activity, lower diesel prices have allowed us to get the food to different places at a much more economical rate.
And I want to talk about things that consumers are not pulling back on. When you look at things like tortillas and potato chips, it's not pulling back on that despite what they saw with price increases last year and even the double-digit price increases that we saw in 2021. Why do you think that we're not really seeing the needle move there? Why is demand still so high?
You know, it's kind of interesting. There's a kind of a pricing dynamic where last year, some of the things we almost seen across the board on this report is things that were low last year. I've seen a catch-up phase this year as the market is kind of filled in behind it. So we are seeing, packaging is up across the board. We're seeing some of the grains, particularly, things that are like tortillas, which are corn-based, have had a higher basic cost. And so we're seeing that catch-up go in those markets as well. So it's kind of interesting how we have this two-step process going on.
And also, too, let's talk about some of those side dishes that have to go with those chips. Of course, guacamole, avocados, a top hit for Super Bowl weekend. Break down how much less they'll cost and if consumers will see that in stores for the Super Bowl weekend.
Yeah, they're down 22% again. I just pulled the data this morning from the USDA, and they're down 22% from this period a year ago. And so it's interesting when we think about that. Last year, we were dealing with a snafu at the border. There was some back and forth between Mexico and the United States. Once again, the higher freight rates. So this year, coming to our rescue is a bigger crop down in Mexico and Peru and better transportation without that kind of uncertainty at the border. So we're seeing a much better supply, and the retailers and the wholesaler have to pass that along because it's very competitive at this point.
So then when you think about the top tips, really keeping your Super Bowl food prices low and your drinks as well, we're seeing obviously that increase in prices when it comes to soft drinks. What's the best way to sort of navigate this space?
It's kind of, you have to spend money to save time. So one of the things we're seeing this year is kind of a change in the retail dynamic. For the last few years, they've been struggling with supply chain and talking about stockouts. This year, we're back to full supermarkets, and they're kind of focusing on what do they want to feature. And so I think if you're a careful shopper and look across 2 or 3 supermarkets or places to shop, you'll find some things featured here and not featured there. So spend your time, do a little pre-checking, and you can probably find bargains in different spots at different times.
Let's talk about some of the drinks that people will be consuming next weekend. You noted in the report that beer prices have jumped dramatically compared to wine and spirits. But where can consumers get a discount when it comes to drinks this Super Bowl weekend?
Well, spirits and wine, 2 different categories, are only up 2% and 3% respectively. And it kind of speaks to that global nature of some of those markets. The wine market in particular, we know, is very global. Australia, South America, Europe, all are great producers. And so we're dealing with the fact that strong dollars brought in more wine. So maybe it's sangria this year. I mean, it's going to be in Arizona, so let's put a little Southwestern spin on the celebration.
And I want to ask you about brand loyalty. Obviously, a lot of people were sort of trying to price compare when inflation was at its highest, starting to see it tip down a little bit, not necessarily flowing all the way, though, down to consumers. What are you seeing there?
Well, it's just one of those timing issues, as you point out, is that, it takes a while. There's 3 stages of getting food to us when we want to enjoy it. There's the producers, the wholesalers, and the retailers. And what we're seeing is sometimes, even though we see pretty dramatic drops at the wholesale price or producer price, it takes quite a lag to get that to drop at the supermarket. I mean, so we're really kind of watching that very carefully. But once it starts, it's kind of an avalanche. And so it's kind of working. We're looking forward to 2023 being a much better food environment for everybody across the categories.
Certainly welcome news for everyone. Wells Fargo there, Chief Agricultural Economist Michael Swanson and Yahoo Finance's own Brooke DePalma. Thank you both. All right, coming up, the battle over student debt cancellation drags on. But what could happen if the Supreme Court rules against President Biden's forgiveness plans? SoFi is uniquely placed in the space. We'll ask CEO Anthony Noto for his take next. SoFi is getting a boost today after reporting record adjusted net revenue for the fourth quarter and giving upbeat guidance for the year to come. Now, this comes as President Biden gears up to back his student debt relief program in court as the backlash continues. SoFi CEO Anthony Noto joins us now alongside Yahoo Finance's own Brian Sozzi. Good to have you both here. So I first want to start, obviously, it's been a bumper time ever since that announcement from President Biden. How much of that do you attribute to what you've seen in the last quarter?
Well, what President Biden has announced and President Trump before him is two things. One, a moratorium on federal student loan borrowers from having to pay their loans. And then subsequent to that, the president announced a forgiveness plan. So since March 2020, our student loan refinancing business has declined meaningfully. It's running at about 25% of what it was prior to March 2020. But that's sort of old news. We've delivered 7 consecutive record revenue quarters in a row. This fourth quarter being a very strong end to 4 record quarters in 2022 for an exceptional year. And we're growing 58% year over year. So we reported $443 million of revenue, up 58%. That's actually faster than the growth rate in Q3. And our profitability improved meaningfully, 55% sequentially to $7 million of positive EBITDA, bringing the full year to $143 million of positive EBITDA. So really hard to find a company doing what we're able to do. And it's really driven by the diversification of our business across being a one-stop shop for your financial needs on a mobile phone. And we're looking to do, roughly $1.9 to $2 billion of revenue, up 25 to 30% in 2023, in addition to achieving GAAP profitability by the end of the year in the fourth quarter.
Anthony, once there is a resolution on the student debt front, how do you expect the trajectory of your student loan business to fare?
If it comes at the end of the period that he's articulated, which means by June, and then there's a 60-day period for the servicers to start the payment send out process, we don't believe we'll see a pickup until that time period, so August, September. And we actually don't believe it will go straight back to where levels were prior to 2020. Just given where interest rates are, it's likely to be a slower build. But that's all factored into our 2023 outlook, which is still quite robust.
For those not familiar with the SoFi model, Anthony, take us through the performance in the quarter for personal loans. Very large uptick there. Is that a sign of growing economic stress?
No, not really. Our market share in unsecured personal loans is quite small at about 6%. So we're stealing market share. We go after what's called a prime customer, high income and high credit. So if you think about a FICO score, our average FICO scores are in the 750s for our loans. And we manage to a life loan loss of less than 8%. And it's been meaningfully below that. In fact, we haven't seen delinquencies even get back to where they were in 2019. I think we're just one of the few companies that understands how to write unsecured credit. And so we're gaining meaningful market share. Having the bank license also helps us meaningfully. Our deposits are now up to $7.5 billion versus about $1 billion at the beginning of the year. And we save about 190 basis points using those deposits, which allows us to give our members really competitive interest rates on their loans. So it's a great, product that we can serve well with our deposits, but also helps us drive revenue for our money and checking account product, which allows us to give our consumers high interest at 3.75% on savings and 2.5% on checking without restrictions and full functionality on your phone.
And that growth that you saw in high quality deposits really stood out. Any plans to sort of reallocate some of that capital into diversifying into other parts of your business?
Yeah, the deposits, we can only really use those to buy loans or originate loans, but we do have ample amount of cash on our own. On our balance sheet, we ended the quarter with about $1.4 billion of pure cash and cash equivalents, another $400 million of investment in treasuries and other securities, and then another $400 million in restricted cash. So really a strong cash position, liquidity position, which allows us to invest. We're at the point now, though, where we can drop about 30 cents of every incremental revenue dollar year over year to the EBITDA line. And that's what's going to allow us to drive to GAAP profitability by the end of the year. One of the huge inflection points we hit in the quarter is that our EBITDA is now equal to stock-based compensation, which is the first step you need to be able to show a path to GAAP profitability. And we're at that point now. The second key inflection point is that our lending net interest revenue is now greater than our directly attributable costs in lending, which means we're not dependent on other forms of revenue streams from lending to cover our costs within lending. So, a lot of things come together. A really strong end to an exceptional year, and those are just some of the highlights.
And I mean, looking ahead down the road, we know that the Education Department earlier this month said that it wants to transform the current income-driven repayment program on some of these federally backed student loans. Any inkling of perhaps what that might be and what that might mean for your business if there is an overhaul of the system?
Yeah, there's already an income-driven repayment plan that exists, and there's a new one that's been announced by the Department of Education that is much more favorable for people to do. We think these types of programs are really critical to helping people that have taken on too much student loan debt, or in some cases were misled and they don't have the ability to pay it back. And so we have to create programs for targeted groups of people. The programs that we don't support are widespread programs that give to the rich or give to the wealthy or give to the people that are fully capable of paying back their student loans. And unfortunately, the administration, the Department of Education hasn't taken that approach, and they're wasting taxpayers' dollars. We should absolutely fund those people that need the help. We should forgive those people that need the help. But those that are capable of being paid, those that are capable of paying need to be put back into payment, and they shouldn't have their loans forgiven either. And I think that's the real rub. There's currently a debt ceiling issue that's coming. If they just eliminated the moratorium on student loan payments, they'd recoup $5 billion of tax revenue on a monthly basis, which could help fund some of that debt with better servicing. And so it's right now a political quagmire. And unfortunately, we don't have leaders in Washington that are thinking about the taxpayer every day and using these blanketed programs to subsidize people that don't need it.
Anthony, well, on the topic of Washington, we got a key Federal Reserve meeting this week, likely get another interest rate hike from the Fed, likely a couple more on the way. How does that impact your outlook for originations in your home business and other parts of the business this year?
Yeah, so right now we're benefiting from three strong businesses. So we have the lending business, which you discussed, which is about 60% of our revenue that's doing quite well. Two is our tech platform business, which we enable 130 million accounts in banking-like accounts or B2B payments. And that tech platform business is doing quite well at around $80 million. And then we have our financial services business, which includes checking and savings, brokerage, cryptocurrency, robo accounts, as well as credit card and insurance. And that finished the quarter at about $60 million, a little bit above that. All three of those businesses had record revenue quarters, which contributed to our seventh consecutive revenue quarter overall for the company. So we feel like we're in a really good position to be able to operate in the environment. We do expect the Fed to continue to increase rates to a peak of about 5%. And then following the forward curve, see 2 rate cuts after that. And our outlook for 2023, that's calling for 1.9 to 2 billion of revenue approximately, which is 25 to 30% growth, factors that in, as well as GDP decline of 2.5% and unemployment of about 5%.
Unrelated to any of this, Anthony, I know you're a big football guy. Who wins it all? Who wins the Super Bowl?
I'm not going to make a prediction yet. Yesterday's outcome for our hometown 49ers was quite unfortunate. Obviously, the Eagles have a great team, and I think are going to give the Kansas City Chiefs a really tough time. And, maybe as we get closer, we can get back on and give you a point of view. But I'm still licking the wound, so to speak, of seeing our hometown team, the 49ers, just have some unfortunate turn of events with Brock being hurt and then the backup quarterback, Johnson, being hurt and really not even being able to compete in a way that you would want to on such a big game.
Indeed. I mean, here in the Washington area, no love for the Philadelphia Eagles, but I'll keep my predictions for now. A big thank you for joining us, SoFi CEO Anthony Noto and our very own Brian Sozzi. Thank you both.
Thank you, guys. Appreciate it.
You're so welcome. All right, coming up next, check the calendar. There's almost too much to keep an eye on this week. Luckily, we'll have the breakdown you need to plan ahead. That's up next. Investors are bracing for a busy week ahead with big earnings on deck. And of course, the Fed set to make its next rate decision, of course, expecting that to be 25 basis points, but we'll be passing through any of the wording that we hear from Fed Chair Powell as well. So as we're taking a look here, we've got Monday, we've got GE Healthcare, SoFi, Whirlpool, and also taking a look at Caterpillar, ExxonMobil, the energy stocks there. McDonald's will be a good gauge of what we might expect from consumers. Also AMD, we know the chip makers have been under pressure, keeping an eye on that and see how that's impacted their earnings on Tuesday. Taking a look, of course, more tech on Wednesday. You have Meta, and of course you have the embattled pandemic darling Peloton coming in on Wednesday. You know, they've tried a number of measures to get more customers on board and focus on subscriptions, going into stores like Dick's Sporting Goods, teaming up with Amazon as well. Speaking of Amazon, we'll see them reporting on Thursday, along with Apple, Alphabet, Starbucks, and car maker Ford, and also another chip maker there, Qualcomm as well. So keeping an eye on a lot of big earnings that might be a good gauge for consumers. Also a notable week ahead for pharma giant AbbVie. Now, the company's dominance over the world's best-selling therapy drug Humira is set to end as a new copycat version enters the US market this week. No drug had previously achieved global revenues topping $20 billion before Humira, so this could be a real game changer here. All right, well, let's do a final check of the markets before we go. We see they're still in negative territory there. It was oscillating this morning, but as we head into the noon hour, under a bit more pressure there. The Dow there down 0.4%. The S&P 500 there down almost 1%. And the tech-heavy Nasdaq down 1.5%. All right, well, we'll also take a look at what we're seeing in the Chinese components as well. We're seeing Alibaba, as we mentioned earlier, still under pressure. They're down more than 5%, along with Pinduoduo and JD.com. We'll be keeping an eye on Chinese data as a lot of companies wait for that reopening picture. A lot of them pinning their hopes on when that might actually happen and how soon they will reopen, as we still await more accurate numbers on what's been happening with the pandemic out there. But investment interest has slowed, according to the China Beige Book. Well, that will do it for now. I'm Rochelle Akufa. I'll be back at 11 a.m. Eastern. I'll see you then.